Yeah, right. So, good morning, my dear students. Hope you guys are all doing good. Hope you guys are all perfectly fine. So, sorry for the delay in the live session today. So, there was unexpectedly, there is a technical glitch actually. So, my iPad stopped reflecting, but I somehow managed it. So, hopefully, yeah, very thankful that the things are back to the normal. So just let me know those guys who are on live. Please let me know, is everything okay? The stream and all, is everything fine? So yeah, I could see some live viewers. So just give me one quick confirmation that the audio, video, everything is perfectly fine. Yes. Thank you. Thanks a lot. Thanks a lot. Thank you so much, my dear students. Right. So let us resume our discussion then. So yesterday we have started day one of our CA final marathon for September 2025 attempt, and we have completed two chapters mainly. We are done with introduction to the audit, and also we have completed this audit reporting. We had a very comprehensive revision of these two chapters. Now today we will be my target for today's session will be, we have to cover the 500 series revision, then we have to complete the 200 series of the revision. So these are very pretty important standards. 500 series of standards important for MCQs as well as the descriptive questions. Then we have 200 series of the standards, which is also going to be very important for descriptive questions as well as MCQ questions. So I have a target of completing today 500 series. 200 series also we will complete it, and we will try to do SQC and audit strategy planning and program. We'll see how the things will go. We will see. So but today we'll complete 500 series and 200 series. Then depending on the availability of the time, either we can complete both audit strategy planning and program and SQ and quality control, or we might end up with doing one chapter. So today being Sunday, we will extend it also a little bit. I am ready to extend my session, and even now, unfortunately, our live has started late by 30 minutes. So I am ready to sit here and do that thing for you all. So I expect the same from you. Please do have the patience. Sit here. We will learn a lot, right? So without any delay further, let us try to proceed further, right? So we will start our discussion with, we will start our revision with SA to SA 500 series. We'll start our revision with SA 500 series. So guys, we are having different kinds of standards which are issued by ICAI, and we will see even going forward there are multiple categories of the standards. Like we have something called SAs, which is talking about, which is providing guidance regarding audit engagements. If you are a chartered accountant in practice and if you are doing audit engagements, then SA, standards on auditing, will become applicable. Then we have something called SRAs. Whenever you are doing review engagements, then SRE will become applicable. Then we have SAE, standards on assurance engagement. When you are associated with other than historical financial information, then SAE will become applicable. Then we have SRS. Whenever you are doing related services, then SRS will become applicable. See, SRE, SAE, SRS, these are series of the standards. We will have a dedicated discussion. We have dedicated chapters talking about standards on review engagements, standards on assurance engagements, and for standards on related services. We have the dedicated standards. We will talk about them later, at a later point of time. We will talk about it. So now mainly our focus is going to be on standards on audit. First, we will focus on the standards on audit. So in the standards on audit also, we have different series of the standards. We'll be picking up the 500 series now. And the 500 series of the standards, these are the standards which are providing the guidance regarding evidence and the related matters. SA 500 series of the standards are those standards which are providing guidance regarding audit evidence and related matters. Multiple aspects relating to evidence SA 500 series will talk about. So having said that, in SA 500 series, we have multiple standards to cover. We have SA 500, 501, 505, 510, 530, 540, 550, 560, 570, 580. So these are the standards which are mainly relevant for CA final examination. So these are standards we are going to have a first quick recap. So I will start my discussion with SA 500. In the 500 series, I will start my discussion with SA 500. And the title of SA 500 itself, if you look at the title of the SA 500, SA 500 is a standard which is going to talk about audit evidence. SA 500 is a standard which is going to talk about overall audit evidence in general. Now, we have already explained you in the previous session what is the entire process of the audit. So if you remember, the ultimate objective, the final outcome of the entire process of the audit is expression of opinion. But to express that opinion, we need some supporting information. That supporting information in the audit terminology, we are going to call it as audit evidence. The information which supports the auditor's opinion, or the information which forms a basis for the auditor's opinion. So that information in the audit terminology, we are going to call it as audit evidence, right? So that is what the simple meaning of the term audit evidence. So this standard will give you overall basic things relating to audit evidence, what methods are available, how we can obtain the attributes associated with the term audit evidence. This standard is going to give you a brief overview of the concept of audit evidence. See, before we can understand about audit evidence, it becomes necessary for us to know about audit procedures. Why? Because only when you perform audit procedures, from performing that audit procedures only, we are going to get the evidence, right? Just because we are appointed as an auditor, the moment we enter the client's premises, evidence will not automatically come and fall in our lap. We need to put some efforts from our side in order to gather that evidence, and that procedures which auditor is performing to gather that evidence, we call them as audit procedures. So audit procedures is a very broad term. So let us start our revision with by understanding what are the different kinds of audit procedures. So I will say here, audit procedures can be broadly divided into two categories. How many categories? Audit procedures can be broadly divided into two categories. Number one is risk assessment procedures, and number two is further audit procedures. And this further audit procedures can be further divided into two categories. We call them as compliance procedures, and also we call them as substantive audit procedures. So broadly two categories, but if I put it into specific terms, into three categories like risk assessment, compliance, and substantive audit procedures. So let us try to understand what happens in the risk assessment procedures, what happens in the compliance procedures, what happens in the substantive audit procedures. So starting with risk assessment procedures. So in the risk assessment procedures, if you are getting appointed as an auditor of any company, that, see, we all know the main objective of audit is to verify the financial statement and express our opinion. There is no doubt about it. Everybody will agree to that. But that doesn't mean the moment you are appointed as an auditor, the moment you start doing the audit, directly you will go to the accounts department and start verifying books of accounts. This you will not do. So initially, in case if you are getting appointed as an auditor, first thing what you will do is, before you go to the accounts department and start verifying the books of accounts, you try to perform some procedures by which you will try to obtain an understanding. You try to perform some procedures by which you try to obtain an understanding of three things. You try to obtain understanding of entity, you try to obtain understanding of environment, and you try to obtain the understanding of internal controls. First thing what we should do, so before we go to the accounts department and start verifying books of accounts, we need to obtain a good understanding of entity, environment, and its internal control. So what entity my client is, to which environment it belongs, to which industry it belongs, what kind of internal controls are there in my organization. So first we need to obtain an understanding of entity, environment, and its internal control. Sir, for what purpose, sir? To identify and assess. What is the purpose of understanding the entity, environment, and its internal control? To identify and assess the risk of material misstatement. So to find out the risk of material misstatement. Sir, what is risk of material misstatement? The chance of happening of misstatement in the financial statements. Where there is a possibility of happening of material misstatement in the financial statements, that susceptibility, that chance we have to find out. So to find out that, we understand the entity, environment, and its internal control. That procedures we are going to call them as risk assessment procedures. Now coming to the compliance procedures. So first we will take some 1-2 days of time. We try to understand about entity, environment, and its internal control. And we will identify risk of material misstatement. In which area risk is higher, in which area risk is lower, that risk we will identify. Next, what we will do. So then what we will do is, we will not immediately once again jump to the accounts department and start verifying the books of accounts. Then we perform some procedures where we try to obtain audit evidence regarding operating effectiveness, where we try to obtain evidence regarding operating effectiveness of internal controls. See, at the risk assessment procedures, we get a basic understanding. At the risk assessment procedures, we try to make a list of all the controls the client is having. But just because controls are there, it doesn't mean they are operating effectively. So whether controls in the organization are operating effectively or not, we need to perform some procedures to determine the operating effectiveness of controls. That procedures we call them as compliance procedures. There is other name for compliance procedures. We also call it as test of controls. What do we also call it? We also are going to call it as test of controls. So whatever it is, we try to perform risk assessment, then we go to the verify internal controls and try to obtain evidence regarding operating effectiveness of internal controls. And once we have completed that compliance procedures, then we will go to substantive audit procedures. Sir, what will happen in the substantive audit procedures? This is where the ultimate audit is going to happen. So here what we will do is we try to get the books of accounts of the client, we try to get the financial statements of the client, and we try to determine whether that books of accounts and financial statements are reliable or not. We try to check the supporting documents, we try to ensure that accounting data and financial statements are correct or misleading. So actual verification of books of accounts and financial statements we will do, and that procedures we are going to call them as substantive audit procedures. So ultimate evidence, whatever we require for the purpose of expression of opinion, that evidence we are going to get it only by way of performing of substantive audit procedures. In the risk assessment procedures, we only understand the entity. In the compliance procedures, only we test the internal controls. And see, this understanding is very, very important. Why? Because throughout the standards, we will see risk assessment procedures, compliance, substantive. So going forward, when you come across this terminology, you should not be keeping the blank faces. You should have the good conceptual clarity. And between compliance procedures and substantive audit procedures, there is a relationship. What is that relationship is? Auditor will perform compliance procedures. From that, he will get to know the operating effectiveness of internal controls. And on the basis of that findings of the compliance procedures, the auditor is going to determine nature, timing, and the extent of the audit, substantive audit procedures. So on the basis of outcome of the compliance procedures, the auditor is going to determine nature, timing, and extent of substantive audit procedures. That means if he finds that controls are effective, he will perform less substantive audit procedures. If he finds that controls are not effective, he will perform more substantive audit procedures. So the nature, timing, and extent of substantive audit procedures will be decided on the basis of outcome of the compliance procedures. Able to understand everyone? Clear and comfortable? So this is what regarding different types of audit procedures. Okay, now by performing these procedures, we are going to get something called audit evidence. We are going to get something called audit evidence. So this evidence, most of the audit evidence is going to come from accounting records. Majority of the evidence, whatever auditor is going to use, or whatever auditor is going to gather as a process, as a part of the audit, that we are going to get it from accounting records like books of accounts, financial statements, and everything. Supporting documents all will include it here. But accounting records, agreed, accounting records is a major source of evidence for the auditor, but it is wrong to say accounting records are the only source of evidence. The auditor can also get evidence from other information apart from accounting records. Also from other sources also, auditor can get the audit evidence. Like when I say other than accounting records, what will be included here is MOA, AOA, minutes of the meeting, external confirmation. So like that, there could be other information also which can give the audit evidence to the auditor. So whatever it is, auditor is going to get audit evidence from the accounting records, or he can also get the evidence from other information as well. Okay. Then see, whenever there are different types of audit evidence also. Depending on nature or form, we can divide the audit evidence into three categories. One is documentary, other one is oral, other one is visual. The names itself say, if you get it in a written format, documentary; if you get it in oral format, visual. If you are getting in a word spoken oral format, and if you are getting by way of looking at something, that will be a visual evidence. And depending on the source, evidence can be further divided into two categories. One is internal evidence, and the other one is external evidence. One is internal evidence, other one is external evidence. Internal evidence is the evidence which is originated within the client's organization, whereas external evidence is the evidence which is originated outside of the client's organization. So you tell me, between internal versus external, which evidence will be more reliable? Always external evidence is going to be more reliable than when compared with the internal evidence, because that is getting generated outside of the entity's premises, on which the client's management and staff will have less control over it. Next, see, whenever we use the phrase audit evidence in the subject of audit, whenever we use the phrase audit evidence in the subject of audit, it will always be preceded by two terms. It will always be preceded by two terms. Even in the audit reporting chapter also we have seen, they will not just say evidence, they will always say sufficient and appropriate audit evidence. So wherever the term audit evidence is used throughout the subject of audit, they just don't use it in a standalone manner. They try to prefix two attributes to the term audit evidence. They always ask the auditor to obtain sufficient and appropriate audit evidence. Now, what do you mean by sufficiency? What do you mean by appropriateness? Sufficiency is a measure of quantity of audit evidence, whereas appropriateness is a measure of quality of audit evidence. Sufficiency is a measure of quantity of audit evidence, whereas appropriateness is a measure of quality of the audit evidence. So they have only told what is the meaning of sufficiency, what is the meaning of appropriateness, but which evidence will be sufficient, which evidence will be appropriate, that is something which has to be decided by the auditor himself using his professional judgment. what evidence will constitute sufficient, how much quantity of evidence will be considered as sufficient, what quality will be considered as appropriate. That is something which auditor himself has to decide using his professional judgment. So using his knowledge, experience and training, the auditor has to decide how much quantity will be sufficient, how much quality will be appropriate. Whereas in order to determine how much, while taking that decision, while arriving at that conclusion, how much quantity will be sufficient, how much quantity will be appropriate, the auditor will consider various factors. Like if you take the sufficiency, he will consider various factors like size of the population. If the population is bigger, we need large quantity. It depends on risk of material misstatement. Higher the risk of material misstatement, higher quantity of audit evidence we want. It depends on materiality. So if the item is more material, more evidences will gather. Less evidence, less material, less evidences we will gather. It depends on effectiveness of internal controls. If the controls are more effective, less evidence. If the controls are less effective, more evidence. Clear? On the other hand, appropriateness of the audit evidence, it depends on two factors. It depends on relevance and it depends on reliability. So reliability means the trustability of the evidence. If the evidence is more reliable, that will be more appropriate. And reliability once again depends on source and nature. Source and nature. Like between internal, external, which one is more reliable? External is more reliable. Between documentary, oral, visual, which one is more reliable? Documentary is more reliable. So appropriateness depends on relevance and reliability is further going to depend on source and nature of the evidence. Everybody comfortable till here? Right. Then apart from that, we need to understand one more important thing regarding this SA 500. What are the various methods to obtain audit evidence, or what are the various procedures? Also sometimes they use it, methods, techniques or specific procedures to obtain audit evidence. See, audit is a universal subject. The beauty of the subject of audit is universal. All over the world, the subject of audit is going to remain uniform. Country to country, accounting policies, accounting principles, accounting standards might change, but country to country, audit will remain the same. So across the world, universally, anywhere you do the audit, for obtaining audit evidence, we have only 7 methods or 7 techniques available. Wherever you go in the world, anywhere in the world, if the audit is happening at any such place, there are only 7 methods which auditors are using to obtain the evidence. So what are that 7 methods which auditors are using is, number 1 is inspection. So if I list down those things here, so if I go to the material, let us have a look at the material. From here itself, we will try to learn. Yes, if you see here. So universally, we have only 7 methods to obtain audit evidence. Number 1, inspection. Number 2, we have inquiry. Number 3, we have observation. Number 4, we have external confirmation, recalculation, reperformance, and analytical procedures. So across the world, wherever you do, wherever the audit is happening, there all the auditors are making one of these 7 methods, or they might be using a combination of these methods. So repeat everyone, what are the 7 methods of obtaining audit evidence? Inspection, inquiry, observation, external confirmation, recalculation, reperformance, and analytical procedures. Sir, what exactly happens in each of this method? If you look at inspection, inspections contain 2 aspects. If you are either doing documentary examination, if either you are doing examining documents or records, like that means you are we are doing the record examination, or even if you are doing physical examination of an asset, that will fall under inspection. Like if I'm checking supporting documents, I'm doing inspection. If I'm doing physical verification of the asset, I'm doing a inspection there also. On the other hand, inquiry. Sir, what do you mean by inquiry? Inquiry means seeking information from the knowledgeable person by way of asking the questions. You find that some person, you believe that some person will possess the required information, you go to him, ask the question, get the responses. That is inquiry. And this inquiry can be a formal written inquiry, or it could be an informal oral inquiry. And inquiry will give you less persuasive evidence than when compared with all other methods. Inquiry will give evidence, but it will be less persuasive, it will be less convincing evidence. So why evidence from inquiry is less convincing is because you can't expect anybody to come and voluntarily disclose what mistakes they have done. So that's why inquiry will give evidence, but it will be least persuasive when compared with all other methods. And by doing inquiry, 3 kinds of information you will get. Either you will get new information which you are not previously aware of it, or the information which supports or which corroborates with the information which you already know, or the information which differs from the information which you know. So by doing any inquiry, we can get only 3 kinds of information. Number 1, altogether new information which you are not previously aware of, or information which supports the information which you already know, or information which contradicts with the information that you already are aware of. So by doing inquiry, only these three kinds of information you are going to get it. And as I've told, evidence which you are getting from inquiries is less reliable. Sir, then what do you mean by observation? Observation means looking at the process being performed by others. Observation means what? Looking at the process being performed by others. Like for example, I want to obtain evidence regarding inventory. So management is doing physical verification. I am sitting and observing whether management is doing physical verification properly or not. So here I am looking at the process being performed by others. That method we call it as observation. See, observation will give evidence, but the problem is the reliability will be restricted only till the point of time such observation is taking place. Why? Because when you are not observing, what is the guarantee the same person will do the same activity in the same manner? So there is no guarantee, right? So that's why observation, yes, it will give reliable evidence, but its reliability is restricted only to the extent that observation is taking place. Then comes external confirmation. Sir, what do you mean by external confirmation? Obtaining a direct written response from a third party. So if you want to know whether debtor's balance is correct, creditor's balance is correct, bank balance is correct, you can get to know about it by way of getting a written confirmation from the third party, that we call it as external confirmation. Then recalculation is mainly relating to checking of arithmetical accuracy. Today this method is no longer relevant. Why? Because today all the calculations are getting assigned to the software. So here in the today's environment, there might not be such a need to verify the arithmetical accuracy. Then we have another method, reperformance. Reperformance means what? A process which has already been performed by the management or entity. Auditor is reperforming. Auditor is independently executing that process once again to get the evidence. So reperformance will give you best evidence. Why? Because you are executing independently the transaction once again. But the problem with the reperformance is it is very, very time consuming. It is very much a time consuming. It will take a lot of time, but it will give you best evidence. And then finally we have one more method for obtaining evidence, which is analytical procedures. The name itself says it is not just some routine checking, it is analytical. Here we do analysis. Sir, what we do in the analytical procedures? In the analytical procedures, what we do is we try to study the relationship between financial and non-financial information. We try to study the relationship between financial and non-financial information, and on the basis of studying that relationship between financial and non-financial information, we evaluate whether financial information is correct or not. So basically, instead of doing the routine checking the supporting documents and all, we try to study the relationships, like we do the ratio analysis, and from that we find out whether the financial information is correct or not. That we call it as analytical procedures. So universally across the world, we only have these 7 methods to obtain audit evidence: inspection, inquiry, observation, external confirmation, recalculation, reperformance, and analytical procedures. Clear, everyone? Right. And one more important thing, one more last concept which I will try to explain from Sep' 500. This is relevant for your CA final examination. And very often you come across a term called assertion. Very often at every chapter, in every standard will come across this term called assertion. Sir, what do you mean by assertion? Assertion means representations which are made by management. Assertion means representations which are made by management regarding account balances, class of transactions, and disclosures. So regarding various items of the financial statements, whatever assertions, whatever statements, either implied or explicit, so all that representations made by the management regarding various items of the financial statements, which we call it as assertion. Like if I have to put you simple terms, take for example balance sheet item. On the balance sheet there is a fixed assets. They have shown fixed assets at some value. By showing that fixed assets, management is making various representations, like they are telling that fixed assets are in existence, fixed assets they have completely recorded, and fixed assets are properly valued, and the company is having the rights against that fixed assets. So all these are representations impliedly made by the management. All this we call them as assertions. Similarly, if you take any long-term borrowing, they have shown in the balance sheet some long-term borrowing. By showing that long-term borrowing, here also they are making various representations, like they are saying that these liabilities are in existence, they have completely recorded the liabilities, they have valued that liabilities properly, and they have an obligation to pay the amount of that liability. Similarly, if you take the P&L item, say for example we have revenue. When they have shown the revenue at certain figure, they are making various assertion here also. Here they say revenue transactions have occurred, occurrence assertion. They have completely recorded all the revenue transactions. They have measured the revenue correctly, and they are making a cutoff assertion. That means which says that they have recorded the revenue only which belongs to the current year. So like this, whatever representations which are made by the management regarding various items of the financial statements, that I call it as assertion. And frankly, and typically if you see here, as an auditor, when I try to do the audit, I try to obtain the evidence regarding these assertions only. Like if I have to verify fixed assets, I will try to obtain evidence regarding whether fixed assets are in existence, whether they are completely recorded, whether they are valued properly, and whether there are rights of the company against that assets. If I have to verify revenue, what things I will try to verify? Whether revenue has actually occurred, whether they have completely recorded, whether they have measured properly, whether it belongs to current year. So basically, whatever representations which management is trying to do, only those regarding those representations only as an auditor, I will try to obtain the evidence. Understood? That's all. So this is what regarding SA 500. So successfully we have completed SA 500. Now we will try to cover SA 501. We will try to cover SA 501. So for this, I have a kind of charts here which will help us for our quick revision. Right. So all this I have made it available on the website, so you can have a look at them. Right. So SA 501, sir, what does SA 501 talk about? So SA 501 is also talking about audit evidence only. So if you see here, SA 501 is also talking about audit evidence. Sir, but we have already seen the standard for audit evidence. Just now we have covered SA 500. So the difference between SA 501 and SA 500 is SA 500 is a standard which is talking about overall audit evidence in general, whereas SA 501 also is the standard which is talking about audit evidence, but it will talk about specific considerations for selected items. So this standard has selected 3 items. This standard has selected 3 items where they are giving a special guidance to you. Sir, what are the 3 items which are selected on which SA 501 is giving a special guidance to us? Number 1, how to obtain audit evidence regarding existence and condition of inventory. As an auditor, what things you can do in order to obtain evidence for obtaining audit evidence regarding existence and condition of the inventory, and how you need to obtain audit evidence regarding completeness of litigations and claims. Number 3, how you can obtain sufficient and appropriate audit evidence regarding presentation of the segment information. So 3 items they have selected: how to obtain evidence regarding existence and condition of inventory. Number 2, how to obtain evidence regarding completeness of litigations and claims. Number 3, how to obtain evidence regarding segment information. So let us try to understand what guidance does the standard give in order to obtain evidence regarding these 3 selected matters. We will try to understand it. First of all, coming to existence and condition of inventory. So if inventory is there in the balance sheet of the company, are you required to obtain sufficient and appropriate evidence regarding that inventory? The answer is 100% yes. Yes, we need to obtain audit evidence regarding that inventory. Sir, but how can I obtain that evidence? So the standard says that the standard is telling you a few steps here. So as an auditor, what you are supposed to do is, in order to obtain audit evidence regarding the inventory, so every management will do physical verification of their stock. Either they will do it on the balance sheet date or they will do it close to the balance sheet date. The management of every company will do a physical verification of their stock. Many entities will do on the balance sheet date, and some entities will do something close to the balance sheet date, either 5 or 10 days close to the before or after the balance sheet. They will do it. Management will do it. And whenever management is doing that physical verification, they will inform the auditor. They will inform the auditor. Now, as an auditor, you should try to attend that management's inventory counting process. As an auditor, the first step which you as an auditor to do are required to do to obtain audit evidence regarding existence and condition of inventory is, the management of every company will do physical verification, and as an auditor they will tell you. So as an auditor, it is your responsibility to go and attend that inventory counting process. Management will do the inventory counting. You have to go and attend there. Sir, by attending there, what I am supposed to do? So after you have attended that inventory counting process, what you should do there is, you should go there and evaluate the management process. That means you try to understand what process management is following for doing that inventory verification. Number 2, sit there and observe the management counting. Sit there and observe how the management is doing that counting. And inspect the inventory. Randomly, you check the quality of the inventory, inspect the inventory. And you also try to perform the test counts. If you are feeling bored sitting there idle for a long period of time, what else you can do is, you can go and perform the test counts. On a sampling basis, you can also do the counting. So whatever it is, management will do physical verification. They will call you. It is your responsibility to go and attend that inventory counting process and follow these 4 steps, perform these 4 steps. Okay, evaluate the process, observe the management counting, inspect the inventory, and perform the test counts. And if they are doing inventory counting on the date of balance sheet, well and good. If they are doing the inventory counting on other than balance sheet date, say for example, management is doing inventory counting on 10th of April 2025. So you will go there and perform that 4 steps. You are satisfied with the quantity of the stock. But here what you need to do is the stock which is there on 10th of April, that will not come in my balance sheet. The stock as on 31st of March will come in my balance sheet. Now you have to do the reverse calculation. So how you will do the reverse calculation? You will take the stock as on 10th of April, that stock you will take, and whatever sales that have been made from the balance sheet date till the counting date, that you will add it, and whatever purchases that have been made from the date of the balance sheet till the date of counting, that you will reduce it. The balancing figure should be matching with my stock as per the balance sheet date. Yes or no? So this you need to verify. You need to perform audit procedures on these intervening transactions, sales and purchases which are made from the date of the balance sheet till the date of the counting, that we call it as intervening transactions. On that also you need to perform some audit procedures. So whatever it is, you try to attend the management's inventory counting process. See, sometimes what will happen is management is doing inventory counting. They have informed the auditor also, but the auditor is unable to attend that inventory counting process. Management is doing inventory counting. They have invited the auditor also, but because of some circumstances, auditor is unable to attend that inventory counting process performed by the management. Then what he is supposed to do? Then the standard says, if you are unable to attend the management inventory counting process, auditor shall himself do the physical verification on a test checking basis. You have to plan the physical verification on some alternative day. If you are unable to attend management inventory counting, you take your team, plan the inventory verification on some alternative date. You have to do the counting on your own. So if you are unable to attend management's counting process, you shall do the inventory verification by yourself on some alternative date. See, but in some cases, what will happen is management has asked you, management is doing inventory verification, but you are unable to attend. You thought, okay, I will go and do the physical verification on my own, but that has also become highly impracticable now. Management did the inventory verification, they invited you, you did not go. You thought you will do the verification on your own on some alternative date, but that has become highly impracticable. So when I say impracticability, it is not because of time and cost constraint. Impracticability should be because of circumstances beyond your control, like calamities, riots, social disturbances. These are the examples of calamities. These are the examples of impracticabilities. I have a lot of time it will take, lot of distance I have to travel. This is not the reason for impracticability. So whatever it is, if physical verification becomes highly impracticable, then as an auditor, you should perform alternative audit procedures. Sir, what could be alternative audit procedures? That you have to decide on the basis of your professional judgment. There is no hard and fast rule anywhere. So you should try to perform alternative audit procedures to obtain audit evidence. If alternative audit procedures are also not possible, then you have to modify your opinion. If alternative audit procedures are also not available, you have to modify your opinion. And here, generally, the opinion will be, the impact will be either a qualified opinion or a disclaimer of opinion. So why qualified or disclaimer? Why? Because it is a case of non-availability of audit evidence. So if you are unable to go to physical verification, if you are unable to perform alternative audit procedures, this is a typical scenario where you are unable to obtain audit evidence. In that case, you are required to modify your opinion. Either you have to give a qualified opinion or you have to give a disclaimer of opinion. Understood? And one more thing the standard will say here, when you go for inventory counting, these are the matters which you need to pay attention. So matters which are relevant in planning attendance at physical inventory counting. Either you are attending the management's inventory counting, or you are doing the inventory counting on your own. These are the matters which you have to pay attention. So which matters I have to pay attention? You have to pay attention to nature of inventory, stages of completion of work in progress. You have to identify the risk of material misstatement related to inventory. What is the nature of internal control? What kind of controls are operating over inventory? Whether the proper instructions are given for inventory counting. What is the timing? Is it getting done on the balance sheet date or other than balance sheet date? What kind of inventory maintenance system the company is following, perpetual or periodical? The location where the inventory is held, and what is the risk of material misstatement for that? And is there any requirement of expert? In verification of some inventories, we might be required to take the help of expert. Determine, is there any need for the expert? So these matters you have to pay attention. Now, coming to the next part of the standard, coming to the next thing, sometimes what will happen is your client will be the owner of inventory, but that inventory is not in the possession of your client. Your client will be the owner of inventory, but that inventory might be in possession of third party. Do I need to obtain audit evidence regarding that inventory which is there in the custody of a third party? Answer is yes. Yes, even if the inventory is in the custody of third party, then also you need to obtain audit evidence. Sir, how can I obtain audit evidence regarding the inventory which is held in the custody of a third party? So what the standard says here is, if the inventory is held in the custody of a third party, what you can do is you can try to get the external confirmation from the third party. You can try to get external confirmation from the third party. See, generally external confirmations will be reliable, but sometimes if you have a suspicion, if you have a doubt regarding reliability of external confirmation, then you should not just stop with external confirmation. You need to, if possible, try to attend the third party's premises or arrange the another auditor. If you know some other person who is at that location to go and do the verification on your behalf, arrange some other auditor, or even you can verify the documentation between that third party and your client when external confirmations are not reliable. If external confirmations are reliable, well and good. When external confirmations are not reliable, don't just stop with external confirmation, perform this extra steps also. Clear? Everybody understood? So we have tackled the first part of the standard, how to obtain evidence regarding existence and condition of inventory. Now let us come to the second part, how to obtain evidence regarding completeness of the litigations and claims. See, litigations and claims are also one of the important critical area in the items of the financial statements. Now the standard is giving us guidance how to obtain audit evidence regarding completeness of litigations and claims. Whether management has completely disclosed all the litigations and claims in their financial statements, or are they hiding something from the financial statements. Regarding this, you need to obtain sufficient and appropriate audit evidence. And how you can obtain that audit evidence is, the standard SA-501 says, first they are asking you to identify the risk of material misstatement. They are not asking you to directly go and identify the misstatement. First, they are asking you to identify the risk of material misstatement. Sir, how can I identify that risk of material misstatement in the area of litigations and claims? 3 simple steps should perform the below procedures to identify the risk of material misstatement. What are they? Number 1, inquire with the management and entities in-house legal counsel. Just go and inquire with the management, and if there is an in-house legal team, internal legal team, go and communicate with them. Inquire with them. Have they disclosed completely all the litigations or not? Number 2, read the minutes of those charged with governance. So whatever those charged with governance meetings are there, read the minutes of those charged with governance meetings, and even review the legal expenses account. Track the legal expenses account, do the analytical procedures, like when compared with the last year, in the current year, is there any huge significant increase or decrease in the legal expenses? So whatever it is, perform these 3 steps to identify risk of material misstatement. Once again, I'm telling, I'm not finding out the misstatement directly, just I'm identifying risk of material misstatement by doing what? By doing 3 simple steps. So what are the 3 simple steps? Inquiry of the management, review of minutes of the meeting, and verifying the legal expenses. Now, once you have performed that 3 steps, there could be 2 options. There could be 2 outcomes. Yes, there is a risk of material misstatement, or no, there is no risk of material misstatement. That means after I have performed that 3 simple steps, I found that management did not hide anything. There is no suspicion for me. So if you did not find any risk of material misstatement, end the procedures with that 3 steps. Just to perform that 3 steps and end your audit procedures if you did not find any risk of material misstatement. But however, by doing that 3 steps, if you find some suspicion, there might be something hidden in the litigations and claims. If you find that there is a risk of material misstatement, then you need to perform extra procedures. By performing that above 3 simple steps, if you find the risk of material misstatement, then you should perform extra procedures. What are that extra procedures I have to perform? Number 1, auditor shall communicate with entities external legal counsel. Whoever is the entities external legal counsel which the company has appointed, that you have to communicate with him. Sir, how can I communicate with him, sir? You can communicate with him through a letter of inquiry. Through a letter of inquiry, you have to communicate, which will be prepared. Here it is very important. You have to communicate with the entities external legal counsel through a letter of inquiry, and that letter of inquiry should be prepared by the management, and it will be sent by the auditor, and we will ask the entities external legal counsel to respond back to the auditor directly. So auditor has to communicate with entities external legal counsel through what? Letter of inquiry. Who should prepare that letter of inquiry? Management. Who should send it? Auditor should send it. And in that letter of inquiry, you should ask the external legal counsel to respond back directly to the auditor, not to the management. Okay, so if you have sent the letter of inquiry, if the external legal counsel has responded, well and good. There is no complication. But when the problem will arise is, I want the management to draft the letter of inquiry, but the management told, no, we will not draft the letter of inquiry. We will not help you to prepare the letter of inquiry. Or management has helped me to draft the letter of inquiry, but the external legal counsel does not respond. He is not giving me response, or he is prohibited from responding. Because of his ethical requirements, is prohibited from responding. Any of this thing could happen, which creates a bottleneck. If the management gives the permission, they drafted the letter of inquiry, we sent it to the external legal counsel, he responded back. If everything runs so smooth, well and good. But when the problem will come, either management is not drafting a letter of inquiry, or they have drafted, I have sent it, but external legal counsel is not responding, or is prohibited from responding. If any of these things happens, then there is a problem. So then the standard says, if any of this thing happen, the auditor shall perform alternative audit procedures. what he shall perform? Alternative audit procedures he shall perform. Sir, if alternative audit procedures are also not possible, then what I should do, sir? Then you should modify your opinion. And which kind of modified opinion? This will also be a typical case of non-availability of audit evidence. So here also I will give either qualified or a disclaimer of opinion. Able to understand? And not just that, you obtain written representation from the management stating that they have disclosed all the litigations and claims and they are not hiding anything from the auditor. Ask the management to give a written confirmation. And also sometimes auditor will feel that just communicating through a letter of inquiry alone will not be enough. Auditor might feel that it will be better if he goes and directly meets with the entity's external legal counsel. Sometimes auditor will have a feeling that communicating through letter of inquiry alone will not be enough. He might be required to go and meet with the entity's external legal counsel personally. Sir, when such need will arise, the need to go and directly meet with the entity's external legal counsel will arise if the auditor feels that the risk from that litigation is a significant risk, or the matter is very complex to understand, very difficult to understand, or when there is a disagreement between management and external legal counsel. In these circumstances, the auditor might feel that it will not be enough to just communicate through letter of inquiry. It will be better if he can go and meet with the entity's external legal counsel. And there is also one more point which I would like to add here. See, generally what will happen is, if you ask the external legal counsel a general inquiry, so if you post a letter of inquiry, and in that letter of inquiry also, if you are making a general inquiry, like a general inquiry, not asking any specific details, if you are doing a general inquiry, in many cases external legal counsel will not respond. Why? Because they are not free like anyone, so they will have their own duties and all. So if you do general inquiries, they will not respond. So if you want to get a response from the entity's external legal counsel, you have to send a letter of specific inquiry. You have to send a letter of what? Specific inquiry. Sir, what information should be included in that letter of specific inquiry? Number one, you should give a list of all the litigations and claims. Whatever management has communicated with you as an auditor, whatever litigations and claims you are aware of, include a list of all the litigations and claims. And where available, management's assessment of the outcome and estimated financial implications. So all list of all the litigations, and what is the management's assessment, what assessment management has made. Have they determined that it will result into a provision, or have they determined it will result into a contingent liability? Management would have made some assessment. No, what is the management's assessment? And after giving list of litigations and the management's assessment, and in that letter of specific inquiry, you ask the legal counsel, you request the legal counsel to confirm on the reasonableness of management's assessment. So you ask legal counsel to respond, sir, for this litigation, management has made this assessment. Is it reasonable? And also provide further information if the list is incomplete or incorrect. Or even you ask that legal counsel, sir, these are the list of litigations I got to know. Is there anything missing from this list? So like this, if you could draft a letter of specific inquiry instead of making a general inquiry, the chances of getting the response will be much higher. Understood? So this is how we need to obtain audit evidence regarding litigations and claims. Now let us come to the last part regarding which the standard is giving the guidance. How to obtain audit evidence regarding presentation of segment information. So what things we can do in order to obtain evidence regarding segment information? So if you see here, very simple. When it comes to segment information, we have the standards. When it comes to segment information, we have accounting standards. If Ind AS is applicable, we have a dedicated Ind AS. If accounting standards are applicable, we have a dedicated AS. Simply, we need to check whatever the requirements of the applicable financial reporting framework is there, are that complied with or not. That's it. Why? Because in the accounting standards or Ind AS, they have given guidance how to identify the segments. They have suggested you some methods. They have suggested you some calculations. So you need to just try to understand whether management has identified the segments by following all the requirements given in the accounting standards. That's what even they try to say here. So as an auditor, you should try to obtain evidence regarding presentation and disclosure of segment information. How? By obtaining an understanding of methods used by the management. Try to obtain an understanding of what methods are used by the management in determining the segment information. And then you evaluate whatever methods management have used, whether they are as per the applicable financial reporting framework, and also test that methods, whatever management have used. And wherever suitable, you try to perform analytical procedures. You try to study the relationship. Last year segment information, current year segment information, you compare it with a competitor. Try to perform analytical procedures. Now, if you come to this part, sir, this standard is asking me to obtain understanding of the methods. No, which methods? What things? What are the examples of the matters which I need to understand regarding the methods? So that they are extending it here. So understanding of the methods used by the management, examples of the matters that may be relevant when obtaining an understanding of methods used by the management. So what things you will try to understand? Sales transfer charges between the segments, how the sales are getting bifurcated, how the charges are getting bifurcated, how the assets are getting bifurcated. Comparison with the budgets. If they have budget, segment wise budgets are there, so try to do a comparison with the budgets, and how the assets are getting allocated, on what basis costs are getting allocated, and even you need to check consistency with the previous period, or last year whatever principles have been followed regarding segment information in the current year also it has been consistently applied or not, that you need to check it. Clear everybody? So this is what SA 501 is going to give the guidance about. Now let us talk about SA 505. This is the standard which is talking about external confirmation. This is a standard which is going to talk about external confirmation. Very important. In the recent times, we are seeing a lot of MCQ questions from this standard SA 505. Simple standard, easy standard, and if you are able to understand the concept at a reasonable level, easily some MCQs you can answer it. So SA 505, they are talking about external confirmation. If you remember, in the SA 500, we have understood what are the various methods for obtaining audit evidence. In that, one of the method is external confirmation. Yes or no? So what is this external confirmation? How we can make better use of it to obtain the audit evidence? All that guidance has been given under SA 505. So let us see what does the standard say. So SA 505, external confirmation. First, that defining the term external confirmation. So what do you mean by external confirmation? So they say that external confirmation is a direct written response which is obtained by auditor. A direct written response which is obtained by auditor from a third party or confirming party. When I say third party, outside of the client's management, outside of the client's staff, a third party like debtor, creditor, banker. So if the auditor is getting a direct written response, see, if you get an oral response, that will have no validity as an external confirmation. In order to be considered as external confirmation, that response must be compulsorily a written response, which can be either in paper form or even it could be in electronic form. Either you can get that written response by way of a printed letter, or even you can get an email, no issue. So a direct written response obtained by the auditor from a third party or a confirming party, that we are going to call it as external confirmation. And these external confirmation requests can be broadly divided into two categories. We can divide the external confirmation request broadly into two categories. Number one is positive confirmation request, and number two is a negative confirmation request. So what is positive confirmation request? What is a negative confirmation request? We'll try to simply understand it. So positive confirmation request refers to such a confirmation request where if the auditor is expecting the third party to respond, either he agrees with the information or even if he disagrees with the information. That means I am expecting a response from the third party in all the circumstances. Like for example, I am drafting a confirmation request. In the letter, I am saying that, sir, I am an auditor of so and so company. I came to know that you are a debtor. My client is saying your balance is this much. Please confirm whether you are required to pay this much amount or not. So that means I am expecting the third party to respond. Either he agrees with the information or disagrees. That means even if he agrees also, I am expecting a response. Even if he disagrees also, I am expecting a response. That I call it as positive confirmation request. Then I have something called negative confirmation request. Negative confirmation request refers to such a request where you are expecting the third party to respond only when he disagrees. I don't want the response from the third party if he agrees with the information. I want the response from the third party only when he disagrees with the information. And also sometimes I will draft the confirmation request in such a manner that where I will not say the amount. What I will say is I will ask the third party only to provide the information directly. Like for example, I will draft the confirmation request something like this. Sir, I am an auditor of so and so company. I came to know that you are a debtor for my client company. Can you please tell me what is the amount which you are required to pay to my client company? What is the amount which you are required to pay to my client company? So that means I'm asking the third party to confirm, to give me the information directly. This will also form part of my positive confirmation request. So either I'm expecting the third party to respond, either he agrees or disagrees, or I'm expecting the information directly from the third party. Both will fall under positive confirmation. On the other hand, if I'm expecting a response from the third party only when he disagrees with the information, that we call it as negative confirmation request. Clear and comfortable? And one more thing, between positive confirmation request and negative confirmation request, you tell me which one is more reliable. See, always positive confirmation request will be more reliable than when compared with a negative confirmation request. That doesn't mean you should not use negative confirmation request at all. No, You can use a negative confirmation request, but in which circumstances you can make use of negative confirmation request, that also standard is trying to help us out. We will see in the rest of the standard, we will see in which kind of circumstances we can make use of negative confirmation request. Clear and comfortable, everyone? Right. So apart from that, a few more definitions they will try to say here. They will also say exception. We need to understand even the meaning of the term exception. Sir, what is the meaning of the term exception? Nothing but the information which is contained in the confirmation request and the response which you got from the third party, if both are not matching, that I call it as exception. Like in the information in the books of accounts of the client, they told that 10 lakhs is owed by the debtor, but the debtor gave me a response that no sir, I am required to pay only 8 lakh rupees. This difference is there. This difference only I call it as exception. And one important thing we have to remember here, exception doesn't always mean a misstatement. If you find an exception, that doesn't always mean misstatement. Why? Because because the exception might arise not only because of misstatements by your client. Exception can also arise because of the third party's mistake also. So that's why when you find a difference, that we call it as exception. When you find exception, don't immediately jump to the conclusion that it is a material misstatement. We have to investigate further whether there is a mistake in our client's books or there is a mistake in the third party's book. Then we have to arrive at a conclusion whether that exception is resulting into misstatement or not. Clear? Then one more term also they define here, non-response. Sir, what do you mean by non-response? So they say two things here. You are sending a positive confirmation request. You are sending a positive confirmation request that has been delivered to the third party, but the third party is not responding. So you send a positive confirmation request and the third party is not responding to it. That we call it as non-response. Or you send a confirmation request either positive or negative, but it has been returned undelivered. Returned undelivered. That means the recipient can't be traced. You got your confirmation back, either positive or negative. If you are sending a confirmation request, either positive or negative, but it was returned undelivered, this scenario we call it as a non-response. One more case, you are sending a positive confirmation request. It was delivered to the third party, but the third party did not respond appropriately. Then that also we call it as non-response. Whereas if you send a negative confirmation request, if it was delivered but you are not getting a response, that we can't consider it as non-response. That we can't call it as non-response. Why we can't call it as non-responses? Why? Because in the negative confirmation request, if you don't get the response, we generally expect that the third party has agreed with the information which is there in the request. Clear, everyone? Right. So this is what regarding non-response. Then, so if you want to obtain the evidence from the external confirmation procedure, you need to follow 4 steps, or you need to have control over 4 steps if you want to get the best evidence from the external confirmation procedure. Sir, what are that 4 steps? Number 1, determine the information regarding which you want external confirmation. Number 2, select the appropriate confirming party. Determine who is that appropriate party to whom you have to send the confirmation request. Then you have to design your confirmation request. You have to do the proper designing of the confirmation request. And once you have designed it, you have to send it and do the follow-up of that confirmation request. So there will be 4 steps involved if you want to get the best evidence from the external confirmation. So what are the 4 steps? Number 1, determine the information which you want to get the confirmation. Number 2, select the appropriate confirming party. Number 3, design the confirmation request. Number 4, send the request and do the follow-up wherever required. Now talking about each and every step in a detailed manner. First one, determining the information to be confirmed. So as we all are aware, generally we use external confirmation to confirm the balances, to confirm the amounts and figures, to get the quantitative details. But do you think the usage of external confirmation is restricted only to this confirmation of balances? Definitely not. We can also use external confirmation for qualitative aspects. For other than accounts and balances also we can use it, like to confirm the terms and conditions of the agreement, to confirm whether the title deeds are really there with the banker, to confirm whether there are any side agreements with the customers. Even for these qualitative aspects also you can start making use of external confirmation. You need not restrict the use of external confirmation only to quantitative aspects. You can also use it for other than quantitative aspects. And next step, once you have selected the information regarding which you want confirmation request, the next important step is you need to identify the appropriate confirming party. Who in the third party is the appropriate person to whom you have to send the confirmation request, that you have to determine. Why? Because if you send the confirmation request to an inappropriate third party, either you will not get the response, or even if you get the response from that inappropriate party, that response will not be reliable. So that's why you need to select the appropriate conforming party. So once you have selected the appropriate conforming party, then you have to design your confirmation request. Sir, while designing the confirmation request, you need to consider various factors, like you need to pay attention to risk of material misstatement. You need to you need to pay attention to presentation. That means you want to present it in a paper form or electronic form. You need to use your past experience. You need to verify that also depends on the assertion, that respective assertion, if it is more risky positive, less risky negative. It also depends on method of communication. So what is the method of communication? Once again, oral, not oral, physical form, email. And also it depends on management authorization. Is the management has given you the approval or not? And few more points also they say here, like if you see here, few more factors which you are required to do is, where is it? Yeah, here it is. So designing the confirmation request, everything I have included here, like risk of material misstatement, layout and presentation, past experience you have to use, what assertion you are addressing, that you have to consider, what is the method of communication, do you need management authorization, because some third parties will say we will respond only when you have management approval. In those cases we need to get the authorization. And also confirming parties ability to provide the confirmation request. Clear? Next, follow up. So once you have done all that, once you have designed the confirmation request, you will not keep it in your locker, right? So you have to send the confirmation request and you have to do the follow up. See, one more thing here, we will do the follow up only in the case of positive confirmation request. When we will do the follow up, we will do the follow up only in the case of positive confirmation request. We will not do it in the case of negative confirmation request. So if you can follow these 4 steps carefully, you will get the best evidence from external confirmation. Then I told that the confirmation request will be of 2 types, positive confirmation request and negative confirmation request. I told which one is more reliable. Positive confirmation request will be more reliable, or negative confirmation request will be more reliable. Positive will be more reliable. Does that mean should I not make use of negative confirmation request at all? No, you can use it. When you can use it, you can use it only in the areas where the risk of material misstatement is very low. Where the risk of material misstatement is low, there we have to use negative confirmation request. That's what I have kept it here. Don't use negative confirmation request if the risk is very, very high. Why? Because negative confirmation will give less persuasive evidence. It will give less convincing evidence than when compared with the positive confirmation request. And you should use negative confirmation request as a sole substantive audit procedure only in the below mentioned areas. So if you want to use negative confirmation as the only audit procedure, you can do only when only all the below conditions are met. What are they? Number 1, risk of material misstatement is very, very low. Controls are effectively operating in that area. The population is very small and contain homogeneous transactions. A very low exception rate you are expecting, and recipient doesn't disregard request. That means you know the recipient very well, that if he sees the request he will definitely respond. So that means you don't have any information which makes you believe that recipient will disregard. That means if you know that recipient will disregard, that means he will ignore the request. There you should not send positive. There you should not send negative confirmation request. There you have to send the positive confirmation request. So you can use the negative confirmation request when all these conditions are present. Understood? Next, sir, I want to send a confirmation request to the third party, but the management is refusing to allow me to send a confirmation request. I want to send the confirmation request to the third party, but the management is refusing me to send the confirmation request to the third party. Then what I should do? If the management is refusing you to send the confirmation request, first go to the management, inquire reasons, ask them why they are stopping you from communicating with a third party. Now, if there is a reasonable justification, management gave you valid reason. So they told that some cases going on. If you ask the external confirmation now, the third party will not respond. Why? Because that you can use it as evidence, that that your client can use it as evidence in the court of law. So that's why the third party is not responding. So if there is a reasonable justification, then the standard says try to perform alternative audit procedures. If alternative audit procedures are also not possible, communicate with those charged with governance, and if required, modify your opinion. Why? Because here also it will be a case of non-availability of audit evidence. So if there is a reasonable justification, this is what you are supposed to do. But if there is no reasonable justification, you want to send the confirmation request, but the management is not allowing you to send the confirmation request, and there is no reasonable justification for doing it. And when I ask them the reasons why they are stopping me from communicating with the third party, they're not giving me any reasons at all, or they're giving me all the invalid reasons. In that case, I need to reassess my risk of material misstatement. Initially, you might have thought risk is low, but now you got to know about true nature of the management. Reassess your risk of material misstatement, especially risk of fraud. Then you have to communicate with those charged with governance, and even here also you need to consider modifying your opinion. Able to understand everyone? Clear and comfortable? Right. Now, let us talk about SA 510. So, we have successfully completed 3 standards from the SA 500 series. We have completed SA 500, 501, and also we have completed 505. So, let us now try to proceed further with the next standard, which is SA 510. We will try to revise now. Right. So let us try to understand SA 510. So SA 510 is going to talk about initial audit engagements, and especially in the case of initial audit engagements, what will be the auditor's responsibilities regarding opening balances. Mainly the standard will talk about opening balances, and that too in the case of initial audit engagements. So here we are required to understand the terms first. They are using two terms in the title of the standard. Number one, they are using initial audit engagement. Number two is opening balances. So let us try to understand the meaning of both these terms. First, we will try to understand what is the meaning of initial audit engagement. The name itself says. See, they define that initial audit engagement refers to such an engagement where either previous year was unaudited or the previous year was audited but by a predecessor auditor, not by you. Last year audit has altogether not happened. Say for example, if I am conducting if I am supposed to conduct audit of the financial year 24-25. Now last year 23-24, it is not at all audited. In that case, this year will become an initial audit engagement for me. Or last year it was audited 23-24, last year it was audited, but it was not audited by the same person. It was audited by predecessor auditor. Some different firm has done the audit of the last year. That means last year auditor and current year auditor are different. If I have to put it in simple terms, if the last year auditor and current year auditor both are different persons, then the current year audit will become initial audit engagement. Next, one more term they are using here, opening balances. So what is the meaning of opening balances? Opening balance refers to those balances which are there at the beginning of the financial year. And these are nothing but these opening balances are reflected from closing balances of the previous year. And what does this opening balances reflect? They say opening balances will reflect two kinds of information. How many kinds of information? Opening balances will reflect two kinds of information. It will reflect the effect of transactions which has taken place in the previous year, and it will also reflect the accounting policies which are followed in the previous year. So opening balances will share with you, will reflect to you two information. Number one, opening balances will reflect the effect of the transactions which have taken place in the previous year, and it is also going to reflect the accounting policies which are followed in the previous year. So like this two informations it is going to reflect. What is going to reflect? Opening balances is going to reflect it. Now you tell me, as an auditor, are you required to obtain audit evidence regarding opening balances? Yes. Why? Because these opening balances, no matter how correctly you account for the current period transactions, if the opening balances itself is going to contain a misstatement, no matter how correctly we account for the current year transactions, the closing balances always will have a material misstatement. If the opening balances contain a material misstatement, no matter how much correctly we account for the current year transactions, even the closing balances also will carry a material misstatement. So that's why we need to obtain audit evidence whether opening balances contain a material misstatement or not. Sir, how can we obtain that audit evidence? By performing some audit procedures. How can we obtain the audit evidence regarding opening balances? By performing audit procedures. So what audit procedures I need to perform to obtain the evidence regarding opening balances? So if you come here, what audit procedures I need to perform regarding opening balances? So they say here, read the most recent financial statements, whatever most recent financial statements are there. Like for example, if you are doing audit of 24-25 financial year, what will be the most recent financial statements? 23-24. So read the most recent financial statements and try to obtain sufficient and appropriate audit evidence whether opening balances contain a material misstatement by performing some procedures. Which procedures? Number one, if prior period closing balances have been correctly brought forward, take the last year's balance sheet and check whether the last year's figures are correctly brought forward into the accounting software. Then determine if opening balances reflect application of appropriate accounting policies. Whatever accounting policies that are reflected in the opening balances, whether they are appropriate or not, you have to check it. And perform one or more of the following procedures, like pursuing the audited prior year financial statements, evaluating Whether current year audit procedures provide evidence regarding opening balances. Sometimes you try to perform audit procedures on the current year transactions that will give you evidence regarding opening balances. Like for example, you are conducting audit of the financial year 24-25. You came to know that in the current year on 10th of April, one of the debtor has gone bankrupt. That means if on 10th of April, one of the debtor has gone bankrupt, there should have been some provision as on 31st of March 2025. So like this, when you perform audit procedures on the current year transactions, sometimes you get the evidence regarding opening balances. Remain alert to that. And also perform specific audit procedures regarding opening balances, like taking the opening trial balance from the accounting software, taking the last year audited balance sheet, putting them side by side, comparing the balances. So like this specific audit procedures you have to perform. And also nature and extent of audit procedures. How much nature and extent of audit procedures you will perform on opening balances, that depends on various factors. That means, will you perform more audit procedures on opening balances, or will you perform less audit procedures on opening balances? That is going to depend on factors. Like which factors? So it depends on accounting policies. It depends on nature of the transactions and items of the financial statements. It also depends on risk of material misstatement. Higher the risk, more will be the audit procedures. It also depends on significance. If opening balances are very huge numbers, then also we spend a lot of time on opening balances. And whether prior period financial statements were audited, and if the predecessor auditor was modified. If the last year financial statements have audited, and if the last year auditor has given modified opinion, then the risk is very high there. Then we need to spend more time on opening balances. Why? Because the chances are, in order to avoid the in order to manipulate, the management might do that adjustments in the opening balances. So that's why, especially if the previous auditor has conducted the audit and he gave the modified opinion in the last year financial statements, then you have to be very careful. Then they say audit procedures regarding current assets and liabilities. Regarding current assets and liabilities, what procedures you have to perform? Like sometimes some evidence about opening balances may be obtained through current period audit procedures. Like as I have told, sometimes you perform audit procedures on the current year transactions, but that will give you audit evidence regarding opening balances. And especially for inventories, what procedures you have to perform regarding opening balances is observing a current physical inventory count and reconciling to opening inventory. So you should attend the current year's inventory counting, and you have to do the reconciliation to the opening balances. And you need to perform audit procedures on the valuation, and also you need to carry out some gross profit ratio calculation and cutoff procedures you have to perform. So especially when it comes to inventories, opening balances, these are procedures you have to perform. And for non-current assets and liabilities, for that opening balances, what procedures you have to perform is by examining accounting records and other information. That is the only thing which you can do, and even if required, you can get the confirmation with third parties as well. So whatever it is, we will perform all the procedures whatever we have read now to obtain audit evidence whether opening balances contain a material misstatement or not. See, once we have performed all the audit procedures whatever we have discussed now, there might be two outcomes possible. So outcome number one, opening balances contain a material misstatement. See, outcome number one will be even much other than that. See, if you came to know that opening balances do not contain any material misstatement, if you came to know after performing all the audit procedures, opening balances do not contain any material misstatement, are you required to modify any opinion? Not required. Why? Because if the opening balances do not contain any material misstatement, what is the purpose of modifying the current year opinion? Not required, right? On the other hand, when you performed audit procedures on the opening balances, you got evidence that opening balances contain a material misstatement. You have obtained sufficient and appropriate audit evidence that opening balances contain a material misstatement. So if you have come to know that, if you have obtained evidence that opening balances contain a material misstatement, then you have to give a modified opinion. What kind of modified opinion? Either you have to give a qualified opinion if the effect of that misstatement is only material, or adverse opinion if the effect of the misstatement is material and also pervasive. On the other hand, if the auditor is unable to obtain audit evidence, sometimes what will happen is auditor unable to obtain audit evidence regarding opening balances. Auditor unable to obtain audit evidence. I think I have already written it in the charts here. Yeah. So by performing all the audit procedures, two outcomes could be possible. If the auditor obtains sufficient and appropriate audit evidence that opening balances contain a material misstatement, either give a qualified opinion or adverse opinion. If auditor is unable to obtain sufficient and appropriate audit evidence regarding whether opening balances contain a material misstatement or not, you are unable to perform audit procedures. You are unable to obtain audit evidence whether opening balances contain a material misstatement or not. If that is the case, then you are required to give either a qualified or disclaimer, depending on what is the possible effect of that undetected misstatement. If the possible effect is only material but not pervasive, give qualified. If the possible effect is material and also pervasive, give give disclaimer. And see, one more thing the standard will address. When I say opening balances, I told that opening balance will reflect two things. Opening balance will reflect the effect of the transactions which have taken place, and it is also going to reflect accounting policies. See, when I say accounting policies, there is one fundamental accounting assumption associated with accounting policies. What is that? Consistency. So one of the fundamental accounting assumption which is associated with the accounting policies is consistency. So I need to check whether accounting policies are consistently applied in the current financial year. While verifying opening balances, since I will get to know about what accounting policies are followed in the last year, it becomes necessary for me to obtain sufficient and appropriate audit evidence whether accounting policies are consistently applied. Without any valid reason, accounting policy should not be changed. If there is a valid reason because of which you are changing the accounting policy, then there should be a proper disclosure of the change in the accounting policy. So two things. Number one, without any valid reason, accounting policy should not be changed. Number two, if at all there is a valid reason for change in the accounting policy, that change should have been appropriately presented and disclosed and accounted for. Both the things you need to check. If any of that thing is missing, that means without any valid reason, if accounting policies are changed, that means consistency principle is violated. Or there is a valid reason, that's why the accounting policy has been changed, but the management did not give a proper disclosure of the change in accounting policy in the financial statements, then also I will give a modified opinion. So two things they try to say it here. Even if you see here, yeah, audit reporting regarding accounting policies. If the auditor concludes that accounting policies are not consistently applied, that means without any valid reason, accounting policies are changed, or changes in the accounting policy are not appropriately presented or disclosed. So this, when there is no valid reason, without any valid reason, you are changing, or there is a valid reason for change in the accounting policy, but it is not properly presented or disclosed. In any of this case, the auditor shall either express a qualified opinion or adverse opinion, depending on the effect of that accounting policy being material or material and also pervasive. Clear? And one more last point the standard will say, SA 510, modifications in the predecessor auditor's report. See, last year audit was conducted by the predecessor auditor. He gave the audit report on the last year's financial statements, but the predecessor's auditor report contains a modified opinion. That means if the last year's audit report contains a modified opinion, is there a mandatory obligation on the current year auditor also to give modified opinion? The answer is no. So just because last year's audit report contained a modified opinion, there is no mandatory obligation on the current year auditor also to give a modified opinion. The current year auditor will give modified opinion only when the matter because of which last year auditor gave the modified opinion, if it is not resolved in the current year, if it is relevant for the current year, if it is a material in the current year, then only he will modify. Just because there is a modification, he will not do it. He will also analyze the reasons in the current year. If he feels it relevant, material, and not rectified in the current year, then only he will modify the current year's opinion. Understood? That's all. So this is what regarding SA 510. So SA 510 also we have completed. Now we will talk about SA 530. We will talk about SA 530, which is relating to audit sampling. So this is also one such area, SA 530, where they are asking MCQs. See, they ask descriptive questions mainly from this SA 530 at the CA inter level, but at the CA final level, instead of asking a descriptive question, they are focusing mainly on MCQs when it comes to SA 530. Very simple standard only. If we could pay minimal attention, within a short time we can complete this SA 530 revision. So let us try to understand what does this SA 530 talk about. So as the title, as you could see, audit sampling. So we all are aware that today auditors are not doing 100% verification, and almost 100% verification has become close to impossible. Today the volume of the transactions is very high, and the technology is getting used very rapidly. Organizations are concentrating more on internal controls. So in this today's business environment, still if the auditor says the traditional method of following 100% verification, then audit will not be effective in the today's environment. So today all the auditors, if not all, Most of the auditors are conducting their audit by following the sampling methods. Sir, first of all, what do you mean by audit sampling? First of all, what do you mean by audit sampling? So the standard defines the term audit sampling as something like this. Say for example, there is an entire population. Now, as an auditor, I am not performing audit procedures on 100% of items on the population. Population means large mass of data. When I talk from the auditing perspective, population means entire items in the financial statements or books of accounts. So there is a huge mass of the population. There are huge volume of entries in the population, but the auditor is not performing audit procedures on 100% of items in the population. What auditor will do is he will select a small sample of transactions, and the auditor will perform audit procedures on that sample. On that sample. So how they have put that definition in a technical format is application of audit procedures to less than 100% of items on the population. Application of audit procedures to less than 100% of items in the population. When I say less than 100%, it could be 10 also, 5 also, 2 also, 100, 99 also, 98 also, 95 also, whatever it could be. But auditor is not performing audit procedures on 100% of the items on the population. He is performing audit procedures to less than 100% of items on the population. Say for example, he has taken some 10%. So he is performing audit procedures on that 10% of the transactions, and depending on that procedures, he will form conclusion not just on this 10%, he will form the conclusion on the entire population. He is not verifying 100% of the population. He is applying audit procedures to less than 100% of items in the population. But on the basis of that findings, he will form a conclusion on the entire population, not just on the sample from which not just on the sample of the entire population. Like say for example, there is a class of 1000 students, or let me give an example from the audit terminology only. In one entity, I wanted to verify purchases. Now, when I say purchases, there are total 10,000 transactions. A very big company, say for example, it is a trading or wholesaling company. So they have total 10,000 purchase transactions in the year. But I am not in a position to verify 100% of the transaction. So what I have thought is, let me take a sample. I have taken 10% sample. 1000 transactions have come. So here the population is 10,000, whereas my sample is 1000. I will perform audit procedures on this 1000 transactions only. Now by performing audit procedures on these 1000 transactions, I will have some findings. I will have some observations. Now depending on that findings or observations, I will form a conclusion. I have to arrive at a conclusion. And that conclusion, I will not just form it on the sample, that conclusion I will form it on the entire population. My objective is not to form the conclusion on just a sample. My objective is to form a conclusion on entire population from which the sample has been selected. So that is what the whole objective of the audit sampling. So that's how they have even defined it. Like if you see here, application of audit procedures to less than 100% of items within a relevant population, ensuring that all sampling units will have a chance of selection to provide reasonable basis. Here comes the most important point, to draw the conclusion about the entire population. So my objective is not just to draw conclusion on the sample. My objective is to draw conclusion on the entire population from which the sample has been selected. Now, so the standard says, if you want to make use of the sampling, if you want to perform audit procedures on sampling, you need to first select a sample. No, out of the entire population, I have to select a sample. Now, how to select that sample? The standard says to select the sample, we have two broad approaches. To select the sample, we have two broad approaches. So what are the two broad approaches for sampling? We have something called statistical sampling, and we have something called non-statistical sampling. We have two broad approaches to the sampling. What are the two broad approaches to sampling? Number one, statistical sampling, and other one is non-statistical sampling. Sir, what is statistical sampling? It has certain characteristics, like in the statistical sampling, there will be a random selection. What there will be a random selection. Sir, what do you mean by random selection? Random selection means every item will have an equal chance of getting selected. There will not be any bias. Every item will have an equal chance of selection. So that method we call it as statistical sampling. And also in the statistical sampling, we are going to make use of the probability theories. This method is going to be little scientific. Why? Because we use mathematical concepts, we use statistical concepts, and mainly we use probability theory. And not just that, here we use mathematical concepts and statistical methods, as I've already told. And this method is very suitable in case of those populations which contain a large number of similar items. And the most important factor here is, in the case of statistical sampling, personal bias will be completely eliminated. Since I am giving equal chance of selection for each and every item, there is no scope for my personal bias here. This method is something I can also call it as objective. Unbiased method is statistical sampling. On the other hand, when I say non-statistical sampling, sir, what is non-statistical sampling? That method of sampling which does not have any of the characteristics of the statistical sampling. That means there will be no random selection. We don't use probability theory. We don't use mathematical concepts. We don't use statistical concepts. Sir, if we are not using any of this, you are telling we don't use mathematical theory, we don't have random selection, we don't have scientific methods, we don't have mathematical concepts, then how come we are going to select the sample, sir? Purely on the basis of the professional judgment. Purely on the basis of professional judgment, if we select the sample, that method of sampling we are going to call it as non-statistical sampling. So that's what they say here. It lacks the features of statistical sampling. Then how come auditor will select it? He will select it purely on the basis of personal experience and knowledge of the auditor. And this method is neither objective nor scientific. Here we are not going to use any science-based concepts, and even this method is not objective. That means it is not going to be an unbiased one. It will always be biased. Why? Because wherever I say I am using a professional judgment, always there will be a bias. Right. Sir, two methods are there. No, statistical we have, non-statistical we have. Which one will be comparatively better between statistical sampling and non-statistical sampling? Which method of sampling is comparatively better? So if you ask me personally, I will say the method of statistical sampling is somewhat better than when compared with the non-statistical sampling. Why? Because of its characteristics, because of its random selection, because of scientific, because of mathematical theories, it is comparatively better. Does that mean auditor should use only statistical sampling? Should he completely stay away from the non-statistical sampling? Not exactly. It is completely up to auditor's professional judgment. Whether auditor want to make use of statistical sampling or he wants to make use of non-statistical sampling, that is something auditor himself has to decide, and purely on the basis of his professional judgment. He has to use his knowledge, experience and training and accordingly determine whether he will go for statistical sampling or he will go for non-statistical sampling. That is purely his choice. Then comes the next question. Sir, is sampling mandatory? Is sampling mandatory? Is there a mandatory requirement on each and every auditor to compulsorily verify the transactions on sampling basis? The answer is no. There is nothing statutorily stated. There is nowhere it was stated that auditor has to compulsorily go for sampling. It was not written anywhere. Whether auditor will go for 100% verification or he will go for sampling, that is something which auditor himself has to decide using his professional judgment. That he has to decide, auditor himself has to decide using professional judgment, and he will take that decision keeping various factors in mind. Like as you could see here, what factors will be considered while deciding upon extent of checking on a sampling plan, which means whether auditor will do 100% verification or he will go for sampling, that depends on which factors. These factors he will consider, like he will consider size of the organization under audit, what is the state of the internal controls, whether the books of accounts are adequate and reliable, what is the tolerable error range, and what is the degree of desired level of confidence. So all these factors he will consider, and accordingly he will determine accordingly he will take the decision. Now, what are the factors which are required to be considered while deciding an appropriate sample size? What are the factors which are required to be considered by the auditor while deciding an appropriate sample size? Sir, what do you mean by sample size? First of all, sample size means how many number of items will be there in your sample. Like for example, will your sample size be 10%? Will your sample size be 20%? Or will your sample size be 30%? Or will your sample size be 80%? So that number of items in your population, I am going to call it as sample size. Sorry, number of items in your sample, I am going to call it as sample size. Sir, should I go for bigger sample size or should I go for smaller sample size? It depends on what factors. Should I go for bigger sample size or should I go for smaller sample size? That depends on what factors. That's what this standard addresses. They have told the factors for deciding an appropriate sample size for test of controls separately and for test of details separately. So what are the factors which affect sample size for test of controls, and what are the samples which affect the sample size for test of details? Both they have given here. Let us try to address. So in case of test of controls, first factor, reliance placed by auditor on internal controls. If the auditor wants to rely more on internal controls, more sample sizes he will take. If he wants to rely less on internal controls, less sample size he will take. Yes or no? Why? Because if the auditor has decided to rely more on internal controls, he will verify more number of internal controls or not. So what kind of relationship is there here? Direct relationship is there here. So higher the reliance placed by the auditor on internal controls, more will be the verification. Tolerable rate of deviation. So it also depends on tolerable rate, how much a deviation auditor is willing to tolerate. Here there will be inverse relationship. Inverse relationship. So tolerable rate of deviation is high. That means auditor is willing to tolerate more. Auditor is willing to accept more risk. He will go for smaller sample sizes. On the other hand, auditor's tolerable deviation is very less. Auditor is not at all willing to tolerate any deviation. Then he has to go for bigger sample size. So here he will have inverse relationship. And it also depends on expected rate of deviation. If the auditor is expecting more deviation, bigger sample size. If the auditor is expecting less deviation, lesser sample size. So here you will have direct relationship. Then it also depends on auditor's desired level of assurance. If the auditor want more level of assurance, more sample size he will take. If the auditor is satisfied with lesser level of assurance, less sample size he will take. It also depends on size of the population, but they will say here size of the population will have a negligible effect. It will not have a major effect. It will have a very negligible effect on the sample size. Now similarly, if you see the factors which are going to have an impact on the sample size for test of details, here also they have given the factors. It depends on risk of material misstatement. Higher the risk of material misstatement, larger will be the sample size. So that means what relationship is there here? Direct relationship we have. Next, it depends on relying on other substantive audit procedures. Other substantive audit procedures means analytical procedures they are saying here. If the auditor wants to rely more on analytical procedures, he will perform less test of details. If the auditor wants to rely less on analytical procedures, he will try to take bigger samples in the test of details. So it also depends on how much auditor wants to rely on other substantive audit procedures. Greater reliance on other substantive audit procedures, smaller sample size. That means here there will be a inverse relationship. Then it also depends on desired level of assurance. Once again, direct relationship, higher the level of assurance, more will be the sample size. It depends on tolerable misstatement. Here we will have inverse relationship. If the auditor is willing to tolerate more misstatement, less sample size. If the auditor is willing to tolerate less misstatement, more sample size. It depends on expected misstatement. Once again, it is a direct relationship. If the auditor is expecting more misstatement, bigger sample size. If the auditor is expecting less misstatements, lesser or smaller sample sizes. Next, it also depends on stratification. Stratification means what? Bifurcation, different characteristics. That means if you are able to bifurcate the population into subpopulations, that you can know that the sample size will be lower. For example, if the sample is having different characteristics, if you are able to stratify, if you are able to divide that entire population into subpopulations, now from each of the subpopulation you can easily select small samples. So what do they say here is appropriate stratification decreases the sample size. If you are able to bifurcate the data, if you are able to properly segregate the data, their smaller sample size will be required. If you are unable to segregate the data, you need more sample size. And here also size of the population, like they have told for test of controls, here also they are saying that size of the population will have a negligible effect. Both for test of controls and for test of details, the size of the population will have a negligible effect, a very minimal effect on the sample size will be there. Clear? Next, coming to the next point. Sir, how I should perform audit procedures as per SA 530? So we are almost at the verge of completion of SA 530 also. Please pay attention. So performing audit procedures as per SA 530. Sir, how I need to perform audit procedures? So what they say here is the auditor shall perform audit procedures appropriate to the purpose. So for every item you will have a purpose. For every procedure you will have a purpose. So if you are verifying, say for example, if you are verifying bank payments, check payments, your purpose is to verify whether the payments have been authorized or not. So like that, every area of the audit will have a purpose. You should perform that audit procedures which are fit for your purpose. Sometimes what will happen is whatever audit procedures you have thought of, that will not be applicable for the item which has been selected. Like say for example, you wanted to verify checks. You wanted to verify whether all the checks are authorized or not. Check payments have taken place. You wanted to perform audit procedures to make sure that all the checks are authorized or not. There are total 1000 check payments are there. Out of that, you have taken a sample of 100. So you are taking each and every check and you are checking the signature, whether that signature is as per the hierarchy or not, you are checking. Now in that sample of 100, you got one cancelled check. You got one cancelled check. So what do you mean by cancelled check? While writing the check, one mistake has happened. So that's why what they have done is they have cancelled it. But that has come into your sample. But whatever procedure you have thought, what is the procedure you have thought? You thought to verify, you wanted to verify the authorization. But in your sample, you got a cancelled check. Now, is the audit procedure, whatever you thought of, is it applicable for this cancelled check? No, that procedure is not applicable for that cancelled check. Then what the standard says is, if in your sample a item comes on which you are unable, on which the procedure which you have thought is not applicable, then what you should do is you should drop this item from the sample. You should take a replacement item. Since you can't apply the audit procedures on this item, you drop this from your sample, take a replacement item, take some another check into the sample, and on that you perform audit procedure. Able to understand? So that's what they say here. If the audit procedure is not applicable to the selected item, the auditor shall perform the procedure on a replacement item. If the auditor cannot apply designed or alternative audit procedures, sometimes what will happen is the audit procedure will be applicable. Whatever audit procedure is there, that will be applicable, but you are unable to perform that audit procedure. You are unable to perform that audit procedure. Like if you see here, if the auditor cannot apply designed or alternative audit procedures to a selected item, then it must be treated as a deviation. In the case of test of controls or in the case of test of details, it has to be considered as a misstatement. So if the procedure itself is not applicable, it is a genuine case. We will drop the item, take the replacement item. But the procedure is applicable, but you are unable to perform. Like for example, you wanted to verify the sales. You are verifying the sales. For sales, you wanted to verify whether that sale is genuine or not. So you thought that there are total 10,000 sale transactions are there. You have taken 500 sample. For each and every sale entry, you want to check the supporting documents. For each and every entry, you have to check the supporting documents. Now, while verifying, in that one such sale entry has come. You wanted to verify supporting documents, but the management is saying for that one sale entry, all the supporting documents are lost. All the supporting documents are destroyed. See, whatever audit procedure you have thought, that is applicable for the given item, but you are unable to perform. Why? Because management is saying that all the items are destroyed, all the supporting documents are destroyed. Then you have to consider this as a misstatement. If it is a test of detail, you will consider it as a misstatement. If it is a test of control, you will consider it as a deviation. Understood? Next. Then projection of the misstatement. Sir, what do you mean by projection of the misstatement? See, by performing audit procedures, I will tell you one example. Say for example, you have a total 10,000 transaction. You have a total of 10,000 transactions of purchases. From that total 10,000 transactions of population, you have selected 1,000 transactions of sample. Okay. Now on the sample, you will perform audit procedures. By performing that audit procedures, you will find some observations. Say for example, by performing the audit procedures on the 1,000 transactions, you found out some 10 misstatements. So some 10,000 worth of misstatement you have found it out. Now, this is a misstatement which you find it out by way of performing audit procedures on the sample. But out of 10,000 transactions, by verifying 1,000, you got to know 10,000 worth of misstatement, but you did not verify remaining 9,000 transactions. No. So now what you should do is you have to analyze it. If on 1,000 transactions, I am able to find a 10,000 amount of misstatement, how much misstatement could be there in the entire population? If in my sample itself, I am able to find this much amount of misstatement, how much misstatement could be there in my entire population? So that assessment, that process, we call it as projection. I hope you guys are able to understand. So if in my sample, I'm able to find out these many misstatements, how many misstatements could be there in my entire population? That estimation I have to do, that process I call it as projection. That process I'm going to call it as what? Projection. So that is what they say. The auditor must project the misstatements to the population to assess the scale of misstatement. And sometimes what will happen is, say for example, I have verified the 1,000 sample, and in that I found 10 misstatements. Before making the projection, what you should do is you should divide out of the misstatements you have identified, how much is an anomalous misstatement, how much is a non-anomalous misstatement. So let me put it this way. Total 1,000 sample I have verified. Out of that 1,000 sample, 10 misstatements I have identified. The total value of all that misstatements is 10,000. But before doing projection, what the standard will ask you to do is, whatever misstatements that you have identified, divide that into two categories: anomalous misstatement, non-anomalous misstatement. Sir, what do you mean by anomaly? Something which is exceptional, something which is non-repetitive in nature. Say for example, out of 10 misstatements, one is anomalous, one of a kind. This misstatement will not happen again and again. This is non-representative. Remaining 9 are non-anomalous. That means they have a repetitive nature. So out of these 10 misstatements, one misstatement is anomalous, whose value is 2,000 rupees. And the remaining 9 misstatements are non-anomalous, whose value is 8,000 rupees. Now you tell me for which value I have to do the projection. Should I do the projection for the entire 10,000? Or should I do the projection for anomalous misstatement of 2,000? Or should I do the projection for non-anomalous misstatement of 8,000? I should do the projection of only non-anomalous misstatement. Why? Because when I say something as anomaly, which is non-representative, non-repetitive in nature, so there is no purpose of doing that projection. It will not happen again and again. So you have to do the projection only for anomalous misstatement. That means if in my sample I am able to find 8,000 worth of non-anomalous misstatement, how much misstatement could be there in my entire population? Projection I have to do only for 8,000, not for the 2,000. Understood? So this is what regarding projection. And last concept here, evaluation of the sample results. Now you will perform audit procedures on the sample. By performing that audit procedures, you will have the sample results. That results you need to analyze, that results you have to evaluate. So the auditor shall evaluate results of the sample, and you should assess whether audit sampling has provided a reasonable basis for your conclusions. Has the sampling has provided you reasonable basis for your conclusion or not? That evaluation, that analysis finally you have to do. So this is what the discussion regarding SA 530. So we have completed SA 530 also. Now next thing what we will do is we will take up SA 540. Important standard. From here descriptive questions will come. From SA 540 descriptive questions will come. Mainly descriptive questions only will come. Standards on audit. Where is the standards on audit? Yes. Fine. So important standard, guys. This is not something which will be there at your CA inter level also. This is something which you have to learn it at the CA final level only. SA 540. This standard will be completely new for you. And as I have told, this is a standard where descriptive questions will come. Not MCQ, descriptive question will come here. Compulsory question will come. So let us try to have a quick revision of this. Okay. So what does SA 540 talk about? So SA 540 is going to talk about auditing accounting estimates, including fair value accounting estimates and related disclosures. That means this is the standard which is going to talk completely about accounting estimates. And I have this summary kind of thing also for you. So what exactly is the standard talking about? The whole subject matter of this standard is auditing accounting estimates. This standard is going to completely give the guidance as an auditor how we can obtain audit evidence regarding accounting estimates. See, we all are aware in the process of preparation of the financial statements, generally management will prepare financial statements, and in the process of preparation of financial statements, there will be various areas in the items of the financial statements where management can't measure those items with accuracy. There they need to take the help of estimates and assumptions. There will be various areas in the financial statements where management will be required to make assumptions, where they have to take the subjective decisions, without which preparation of financial statements will not be possible. So like for example, depreciation, it's purely an estimate. Provision for bad and doubtful debts, estimate. Valuation of shares, estimates. So like that, there will be various aspects in the items of the financial statements where management cannot measure with accuracy. They have to compulsorily make use of assumptions and estimates. And without making use of that assumptions and estimates, preparation of financial statements is completely impossible. But if you pay close attention here, whenever we are saying that the management for the purpose of calculation, they are using estimate and assumption, obviously in that area, risk is very high. Obviously in those areas, the chances of happening of misstatements are much higher. Why? Because if you can measure something with accuracy, we can determine whether it is correct or not. But when the management has determined a figure purely on the basis of estimate and assumption, they can change their assumptions and estimates to get the desired outcome. So that's why wherever you find the accounting estimates, that is a very risky area. So that's why even the standards on auditing have also felt that in this area we need to give a specific guidance for the auditor. So that's why they have given this SA 540. Now, first of all, what is the standard dealing about? What is the objective of the standard? For what purpose the standard has been given? So this standard will help the auditor to obtain sufficient and appropriate audit evidence. The standard will help the auditor to obtain sufficient and appropriate audit evidence regarding what? Regarding whether accounting estimates are reasonable or not. See, we are not supposed to obtain evidence whether accounting estimates are correct. No one will expect that from us. We can't comment on the correctness of the accounting estimates. We can only comment whether accounting estimates are reasonable or not, whether accounting estimates are acceptable or not. That we need to obtain evidence. And also, whatever disclosures are required as per applicable financial reporting framework, whether all that disclosures are given or not. These two matters I need to obtain evidence. This is where SA540 is going to help me out. So tell me, what are the two matters where SA540 is going to help me out? Number one, to obtain sufficient and appropriate audit evidence regarding whether accounting estimates are reasonable. Number two, whether the disclosures regarding the accounting estimates as per the requirements of applicable financial reporting framework are given or not. So these are the two areas regarding which I need to obtain evidence. But first of all, what is the definition of accounting estimate? What is a definition of accounting estimate? They say that accounting estimate means it is an approximation. We can't measure something with accuracy. There we do what? Approximation of a monetary amount in the absence of a precise means of measurement. Something you can't calculate precisely. That's why in those areas you are going to make an approximation. That I call it as estimate. And these accounting estimates can be divided into two categories. Those accounting estimates which involve fair values and other accounting estimates. There are some accounting estimates which require fair value adjustments, whereas there are some accounting estimates which does not require any fair value adjustments. Like for example, if I have to give you a scenario, take I have to value the shares. I am conducting audit of some company. That company is holding the shares in another company. As on the balance sheet date, they have to determine what is the value of the share. Now they need to determine the value on the basis of fair value. That means if these shares are sold in the market as on that balance sheet date, how much price it will be able to fetch, that they have to determine, and at that value they have to value the shares. This is an accounting estimate where fair value adjustments are involved. So like that, we can divide accounting estimates into two categories. Those accounting estimates which are involving fair value accounting estimates and other accounting estimates. So if I give you examples of those accounting estimates which involve fair value adjustments are like this, like complex financial instruments which are not traded in an active and open market. Your client has invested in the shares of the company, that to an unlisted company. If you have to do the valuation, you have to determine the fair value. Or share based payments like ESOPs, employee stock option plans and all, and sweat equity shares. So these are the transactions which involve the fair value adjustments. Or property or equipment held for sale. Your client has kept some property for sale. Now you have to do the valuation. How that value will be determined? On the basis of fair value. Or certain assets or liabilities acquired in a business combination like goodwill and intangible assets, brand value, goodwill value. This is also something which will be determined on the basis of fair value. And transactions involving exchange of assets or liabilities between independent parties. That means barter transactions. In the case of barter transactions also, at which value you will recognize? Once again, you have to determine the fair value. So these are the examples of the accounting estimates which involve fair value. So then what are the accounting estimates which does not involve any fair value? Like for example, if you have to create a provision for debtors. If you have to create a provision for debtors, that does not involve any fair value. Out of the debtor, how much the debtor will not be able to repay, that we will determine and create a provision. Is there any fair value adjustments here? No. Inventory obsolescence. How much of your inventory has been damaged? You have to create a provision for inventory obsolescence. No fair value, nothing. Warranty obligations. You have to create a provision for the warranty obligations. So no fair value adjustments. Depreciation. In the depreciation also there is no fair value accounting adjustments. And also provision against carrying amount of the investments where there is an uncertainty regarding its recoverability. Like for example, you have invested in the debentures, but there is a doubt regarding its recoverability. Now you have to create a provision for debentures. There also you will not use any fair value adjustments. Or outcome of long-term contracts or even financial obligations or costs arising from litigations and settlements. So these are the examples of accounting estimates which involve no fair value adjustments. So like this, we can broadly divide accounting estimates into two categories. Now comes the next definition, which is very, very important from the standard, which is estimation uncertainty. Sir, what is estimation uncertainty? The chance that accounting estimate can be wrong. That chance will always be there or not? See, I am using accounting estimate because I don't have precise means of calculation. That's why I have made an assumption. But whenever I have calculated something using an assumption, that assumption can always go wrong in the future. No, that is inherent. No, that is inbuilt. When I am making assumption, that risk is always there. That assumption can go wrong. So that in technical terminology, we call it as estimation uncertainty. So like if you see here, the susceptibility of an accounting estimate and related disclosure to an inherent lack of precision. The chance that there is no precision, there is no exact measurement of that accounting estimate. That means there is a chance that this accounting estimate can be wrong in the future. Say for example, there is one debtor amounting to 100 crore rupees. I created provision for 30 crores. I felt that this debtor will not be able to repay me 30 crores. That's why I created a provision. But the next year, he did not repay me 40 crore rupees. I felt 30 crores will not be recoverable, but actually 40 crores is not recoverable. My estimate has gone wrong. It is always built in the accounting estimate, that we call it as estimation uncertainty. Now, degree of estimation uncertainty. See, you tell me estimation uncertainty, if it is high, there will be high risk or low risk. If the estimation uncertainty is very high, that means if the chance of accounting estimate going wrong is very high, that areas are highly risky. On the other hand, if the estimation uncertainty is low, then it will be less risky. So there will be some items which have high estimation uncertainty. There will be some items which will have low estimation uncertainty. See, what do you mean by high estimation uncertainty? There will be some accounting estimates where the chances of actual results will be very different from the estimates. That is high estimation uncertainty. On the other hand, there will be some accounting estimates where the actual results also will be close to the estimate. There I will say low estimation uncertainty. Like if I show you some examples here, what are the accounting estimates which involve high estimation uncertainty, where the chances of your actual results and the estimate will be very wrong. The chances of your estimate going wrong are very high. What are they? Number one, examples they are saying. Accounting estimates relating to outcome of a litigation. For litigation, we create a provision or contingent liability, but actual outcome of the litigation could be very, very different. It all depends on the court proceedings. So litigations carry a high estimation uncertainty. Similarly, fair value accounting estimates for derivative financial instruments which are not publicly traded. If you are doing the valuation of investments, that too which are not publicly traded, there also estimation uncertainty is very high. Fair value accounting estimates for which a highly specialized entity developed model is used, there are assumptions or inputs that cannot be observed in the marketplace. That means you are doing the fair value calculation completely on entity model. That model will be applicable only for you. It will not be applicable for anybody else. Then also there is a high estimation uncertainty. Similarly, they have given examples of those accounting estimates where there will be low estimation uncertainty. What are the examples? Number one, accounting estimates in entity that engage in business activities that are not complex, very simple business, like a trading entity. They buy the goods, they sell the goods to the retailers. Simple business, simple provisions there. So here the estimation certainty will be very less. Why? Because whatever provision you have created, that will actually turn into reality. And accounting estimates that are frequently made, there will be some estimates which are very frequently made, like rent expense provision you will create. Every month we will do it. So there also the estimation uncertainty will be very low. Or accounting estimates derived from data that is readily available. Like for example, you are calculating the shares, but those shares are publicly traded, that those are listed in the market. So on a ready-made data, you are calculating from the stock market, you are picking the prices and doing the valuation. So their estimation uncertainty will be low. Why? Because you are taking the publicly available data. Or fair value accounting estimates where the method of measurement prescribed by the applicable financial reporting is simple and easily applied. So that means if you come here, if the model is very complex entity developed, then estimation uncertainty will be very high. On the other hand, the method of valuation has been suggested in the applicable financial reporting framework only, and the method is very, very simple, then estimation uncertainty will be low. Next one, fair value accounting estimates where the model used to measure the accounting estimate is well known or generally accepted. Not an entity specific model, it is a well known model. There also estimation uncertainty will be low. And also, if I ask you one question, between fair value accounting estimates and other accounting estimates where estimation uncertainty will be little higher, the estimation uncertainty will be little higher in the case of fair value accounting estimates than when compared with other than fair value accounting estimates. But that doesn't mean all fair value estimates will have high estimation uncertainty. So like they say here, not all financial statement items requiring measurement at fair value involve estimation uncertainty. See, generally as a common statement if I have to pass between fair value estimates and other estimates where the estimation uncertainty will be high. Generally fair value, but it is not a thumb rule that always every fair value estimate will have a high estimation uncertainty. No, there will be some fair value estimates where estimation uncertainty will be low. Like for example, I have to give you, the company is holding the shares and these shares are listed in the stock market. Now for doing the valuation of these shares also, we take fair value, but these fair value will pick from the stock market. Yes or no? So this is a fair value estimate, but the estimation uncertainty is low. Right? So that is what they try to explain here. Not all financial statement items requiring measurement at fair value involve estimation uncertainty. So ultimately, if I have to give one conclusion, sir, whether estimation uncertainty will be high or estimation uncertainty will be low, that is depending on what factors, sir. If I have to summarize it here, I can summarize into 3 factors. So degree of estimation uncertainty varies based on nature of the accounting estimate. What is the nature of accounting estimate? Is it fair value other than fair value? Or the extent to which there is a generally accepted method. Is the method is generally accepted or not generally accepted? Or it also depends on subjectivity. Higher the subjectivity, higher will be the estimation uncertainty. So I can call this heading as factors. What are the factors which will affect the degree of estimation uncertainty? And these are examples. Accounting estimates with low estimation uncertainty example, accounting estimates with high estimation uncertainty example. Clear? So what we have revised in the standard till now, we have revised objective, we have understood definition of accounting estimate, different types of accounting estimate. We understood what is estimation uncertainty, and we have understood what are the transactions which involve high estimation uncertainty, what are the transactions which involve low estimation uncertainty. Then there is something called management bias. If you come to the next point, there is something they are trying to say, management bias. Which means, see, generally whenever management is making an estimate, whenever management is doing a calculation, say for example, they are required to create a provision for bad and doubtful debts. Whenever they are creating a provision, they should do an unbiased provision. That means whatever exact provision is required, that much only they have to create. They should not do under provisioning, they should not do over provisioning. But sometimes there might be bias. That bias might be intentional or unintentional. What do you mean by bias? First of all, say, take the example of provision for bad and doubtful debts only. Say for example, 20% provision is enough, but the management has created 30% provision. It might be intentional or unintentional. See, unintentional means by mistake they might have done wrong assessment and they have created 30% provision. But sometimes management will do it intentionally. They want to underreport the profits. That's why they are creating a higher provision. This is clearly a intentional management bias. So you tell me, is the intentional management bias correct or incorrect? It is incorrect. There the risk is very high or low? Risk is very high. You have to be very careful or less careful? You have to be very careful. So that's what they have. That's what we have one paragraph regarding this. So if you see here, management bias, what do you mean by management bias? Lack of neutrality by the management in the preparation and presentation of information. That means management is not behaving in a neutral manner. They are showing partiality. They'll have lack of neutrality. That we call it as management biases. So if you see here, management bias in accounting estimate. See, all the financial reporting frameworks, every financial reporting framework will call for neutrality. All the standards will say management has to take neutral decisions. But since accounting estimates are imprecise, they can be influenced by management judgment. Since you don't have precise means of calculation, since they are purely assumption based, it is completely depending on management judgment. And these bias can be intentional or unintentional. If they are unintentional, okay. If they are intentional, very much problematic. Higher the subjectivity, higher will be the bias. More subjectivity is involved in the estimate, more will be the bias. And also for continuing audits, for example, if last year also you have only done the audit, last year if you got to know about any bias in the management decisions, in the current year also you have to be very much careful about it. Then management bias can be difficult to detect at an account level. See, at individual level, you can't identify the management bias. Why? Because, say for example, if the management want to show a biased decision, they will not do the bias only in one accounting estimate. They will spread across it. Like for example, if the management wants to decrease their profits for tax reasons, they will not do all the adjustments only in provision for bad and doubtful debts. They will do the wrong adjustments. They will do the wrong accounting estimates even in the inventory valuation. They will do wrong accounting estimates in creating provision for expenses. So at the account level, it is very much difficult to detect, but at the overall level, somewhere it will get reflected. So where there is an intention to mislead, management bias is fraudulent in nature. As I have told, if the management is doing wrong accounting estimates to mislead, that is definitely fraudulent in nature. Next one. Measurement objective, this I will try to summarize it, what they try to say here. See, whenever you are calculating any accounting estimate, that accounting estimate can have two measurement objectives. In one some kind of accounting estimates, there the measurement objective will be to estimate the future. If you take some accounting estimates objective will be to measure the future. Whereas on the other hand, some accounting estimates, we do not measure anything relating to future, we measure only current transactions. Like for example, if you take warranty provisions, an entity is required to create a warranty provision. If the management is calculating the provision for warranty, what is their measurement objective? They are measuring the future. In the coming 1 year, how many people will claim their warranties? They will estimate the future and create a provision. So for some accounting estimates, the measurement objective will be future oriented. Whereas if you take the example of valuation of shares, if the company is valuing the shares, which valuing the investments, there they are not estimating anything about the future. There they are just calculating on the basis of present data. So like that, for some estimates, the measurement objective will be future. For some estimates, the measurement objective will be current data only. So that's what they say here. If I highlight the important points here. So for some accounting estimates, measurement objective is to forecast the outcome. That means to predict the future. Whereas for other accounting estimates, the measurement objective is expressed in terms of value of current transactions. So for some accounting estimates, we do the forecast. For some accounting estimates, we use the current data only. Next. So, okay, now what is the auditor's responsibility? So we understood about all the accounting estimates now, but we did not speak about the auditor's responsibility. So what is auditor's responsibility regarding accounting estimates? So first you need to perform risk assessment procedures. So we can divide the audit procedures into two categories. First, we have to identify and assess the risk of material misstatement regarding, we need to identify the risk of material misstatement regarding this accounting estimates. Sir, how can we identify the risk of material misstatement? That's what they try to elaborate it here. So first thing, when you are performing risk assessment procedures, at the beginning, when you are trying to understand the entity, environment and its internal control, at that point of time, you need to even try to identify, is there any risk of material misstatement for the accounting estimates? At the beginning, when we try to understand the entity, environment and its internal control, even we need to evaluate, even we need to find out the risk of material misstatement resulting from accounting estimates. Sir, but how can I get to know about that risk of material misstatement? First one, you need to understand what are the requirements of applicable financial reporting framework. That means you need to understand accounting standards, Ind AS, and what they are saying about accounting estimates. First, you have to understand the requirements of applicable financial reporting framework. Then you need to understand how management identifies those transactions or events and conditions that may give rise to the need for accounting estimate. So you should go and inquire the management, sir, you are the responsibility. Why? Because see, before auditor, management is having the responsibility to make accounting estimates. So you have to go to the management and inquire them, sir, what process you follow to identify all those transactions which require you to make the accounting estimates? Yes or no? It is a responsibility of the management to identify all those circumstances which require accounting estimates or not. So go and ask the management directly, sir, what procedures you are following, what methods you are following to identify all that events and circumstances which require accounting estimates. Sir, how will I do that? How will I do that? See, here they have given, this is an extension. So obtaining an understanding of how management identifies the need for accounting estimates. So what exactly you will try to understand here? So as you could see here, first point, the management itself is having the responsibility to identify all those transactions or events that give rise to risk of material misstatement, and they are also responsible for making that accounting estimate and disclosing that accounting estimate. So before the auditor, management will have the responsibility to create accounting estimates. For that, first they need to identify which transactions or events require accounting estimates. Once they have identified, then they have the responsibility to make the accounting estimate. Right. So in order to know how the management is identifying, you have to inquire them. Sir, what I have to inquire? So I have to inquire the management whether they have engaged in new type of transactions which give rise to new accounting estimates. Or I should ask them for the existing accounting estimates, whether the terms have changed, whether any new transactions they have entered that will give rise to new accounting estimates, or for the existing accounting estimates only terms have changed, that I need to understand. And also what accounting policies they are following regarding accounting estimates, and what procedures they have followed in the previous year. The same accounting policies are also followed in the current year or not, or have they undergone any change, that I have to go and inquire them. And even I need to understand regulatory or other changes. Is there any change in the law and regulation which have an impact on accounting estimates that I have to inquire, and even I have to go and inquire with them new events or conditions that give rise to the accounting estimates. So whatever it is, at the time of performing risk assessment procedures, first you need to understand the requirements of applicable financial reporting framework. Number two, you need to understand how the management is identifying those events or transactions which give rise to the risk of material misstatement, and what exactly you have to do for that. You have to do the inquiry, and what you have to inquire, that also I have told you. Now coming to the third step, in obtaining this understanding, the auditor shall make inquiries of the management about changes in the circumstances that may give rise to new or the need to revise the existing misstatement. This is just an extension of this point only. Then the ultimate decision in forming an opinion, much care has to be taken in this regard. See, since accounting estimates have a lot of impact on our opinion, so you have to take so much of care while obtaining audit evidence regarding accounting estimates. Okay, next. See, you have understood how the management will identify the events which require accounting estimate. How to understand it, that we have seen it here. Now once the management has identified all those events which require accounting estimates, now they will create that accounting estimate. You need to understand how the management is making that accounting estimates. Once they have identified all the events which require accounting estimates, now they have to create accounting estimates, no? So you should also understand how the management is creating that accounting estimate. So basically what I need to understand is, I need to understand what method is used by the management, or what model is used by the management in creating accounting estimates, and what kind of internal controls they have in the area of that accounting estimates, whether management has taken the help of the expert, like when it comes to employee benefit accounting estimates like gratuity provision, salary gratuity provision, leave encashment provision and all. There the management will generally take the help of actuary. In case of accounting estimates relating to litigations and claims, their management will take the help of the expert lawyer. So try to evaluate whether management has used an expert and what assumptions the management has made in making that accounting estimate, whether there has been or ought to have been a change from the prior period, what method they have used in the last year, in the current year what method they are using, whether both are same or have they undergone any changes, and if so, if any change has undergone, how the management has assessed the effect of estimation uncertainty. If they have changed the method from the last year, how it is going to have an impact on the estimation uncertainty. So like this, once you have understood how the management has identified the events, then you need to understand how they have made the estimates. And wherever you feel that accounting estimates are leading to significant risk, that means wherever estimation uncertainty is high, that will be a significant risk. In that area specifically, you have to evaluate how management has considered alternative assumptions. So wherever estimation uncertainty is high, that will be a significant risk. There you have to pay more attention. There you have to perform specific procedures like what and all assumptions management have considered. See, when I say assumptions, multiple assumptions you can make. Why the management has stuck to this, has restricted to this assumption? What about alternative assumption? Why they have ignored alternative assumption and have stick to this assumption only? So try to evaluate alternative assumptions, and whether significant assumptions used by the management are reasonable. You have to evaluate whether assumptions used by the management are reasonable, and management's intent to carry out specific course of action. They have made assumption, but is the assumption realistic? Can they carry out that assumption? That also you have to evaluate. And also the auditor should develop a range within which to evaluate the reasonableness of accounting estimate. So even as an auditor, what you can do is, depending on your understanding, on your knowledge, you can develop a range that we generally call it as audit range, audit range estimate we call it. So what auditor will do is, he is evaluating provision for bad and doubtful debts. He will evaluate the industry, terms of the conditions, debtors, repaying capabilities and all. So everything he will consider, and accordingly what he will do is, after considering all the factors, he decided that okay, here the provisions could be somewhere around 10 lakhs to 20 lakh rupees. Now he will see whether actual provision is falling within that range or not. So like this, wherever estimation uncertainty is high, there you need to specifically do these steps. And finally, you have to evaluate reasonableness of the accounting estimates and determine whether accounting estimates contain any misstatements. So like this, these are all risk assessment procedures. Basically, if you ask me, all these are forming part of risk assessment procedures. Now once you have identified the risk, whatever risk you have identified, to that you have to respond. You have to respond to the assessed risk of material misstatement by performing further audit procedures. So what further audit procedures you have to perform? Here they will try to say the list here. So the auditor shall undertake one or more of the following, taking into account the nature of the accounting estimates. So what and all he should do? Number one, he should evaluate determine whether events occurring up to the date of the auditor's report provide sufficient evidence. So management might have created a provision as on the balance sheet date. After the balance sheet date, you are doing audit. So during the process of your audit, some advancement might have taken place regarding that accounting estimate. So try to obtain that information. And also test check the data, whatever data management has used for creating accounting estimate, test check it. Evaluate whether method used for management is appropriate. Whatever method management has used, that is appropriate or not, you have to check. Next, testing the extent to which data on which accounting estimate is based is accurate, complete, and relevant. Whatever data management is using for evaluating account, for calculating accounting estimates, is it accurate? Is it complete? Is it relevant? And also source relevance and reliability of external data in case if they are using it. And also, if possible, try to recalculate. You also try to do the calculation of accounting estimate once again, compare it with the management's calculation, and even test check the effectiveness of the controls. Whatever controls they are having in the area of that particular estimates, try to check the internal controls also. And along with all that, you need to even obtain written representation from the management. So regarding what I need to obtain written representation, whether they believe significant assumptions used in accounting estimate are reasonable or not, ask the management to even share the written representation also. And finally, reporting, you need to consider your reporting requirements. So as an auditor, you need to obtain sufficient and appropriate evidence whether all disclosures are required to be given as per applicable financial reporting framework have been given or not. Generally, what disclosures are required to be given by the management regarding accounting estimates is like what assumptions they have used, what method they have used, what is the basis for selection of the estimation, is there any change when compared with the last year, and the sources and implication of estimation uncertainty. Generally, these things are required to be disclosed by the management. I will check whether all these disclosures are given or not. And not just that, you need to include in your audit documentation. So you need to maintain proper audit documentation. In your documentation, you have to include the basis for auditor's conclusion, on what basis you have arrived at a conclusion regarding reasonableness of accounting estimates, and if you find any indicators of management bias. We have seen about management bias, no? So if you find any management bias, that things also you are required to document in your audit documentation. Clear everyone? So this is what regarding SA 540, very important for descriptive. So we have to intentionally little more time. Why? Because this standard is very difficult in learning, but if you understand the flow of the standard, it becomes easy for us to remember it. So this is what regarding SA 540. So students are asking me for break, so we'll do one thing, we'll take just 2 minutes of the break. We'll take some 2 to 3 minutes of the break. After that we will resume. Okay, so just 2 minutes of the break, I will write here. So please do come back after 2 minutes. We will resume our discussion. Right. Okay, guys, let us resume our discussion. So we have completed till SA 540. Now we have four more standards to cover from SA 500 series, which is 550, 560, 570, and 580. Once again, simple standards, easy standards. We can try to cover it in no time. So first we will try to complete 550, 560, 570, 580. Once we have successfully completed this, then we will proceed further and complete the 200 series. Okay, right. So let us now try to understand SA 550, which is talking about the related party transactions. From here itself, we will try to, from the chart itself, we will try to have a quick overlook. Once again, 550 important for the MCQs. So let us try to have a quick understanding of 550, which is relating to related party transactions. See guys, as we all are aware, wherever there is a related party, there is a risk actually. Why? Because you can't influence the independent party, but if someone is related with you, there is a huge scope for manipulation. So that's why wherever related party transactions are there, under Companies Act also we have so many disclosure requirements. We have dedicated accounting standards and Ind AS talking about related party transactions, and there are so many disclosure requirements given under applicable financial reporting for the related party transaction, because that is such a risky area. So even the ICA has thought that since they carry high risky area, we need to give guidance for our chartered accountants to do audit of that related party transaction. With that intention, the standard has been given. So very simply, I will try to cover it, not that significant from the examination perspective, just one or two MCQs, if at all they come, they might come. So, and also very frequently they will not come. So I will try to just give a overview of the standard and will proceed further. So related party transactions, first of all, who is related party? As per the standard, see, at all respective places we have given definition. Under Companies Act we have a definition for related party, under standards we have a definition of related party. So even SA 550 also has played it safe. They told that if just a minute, just 1 minute. See, I think streaming and all is perfectly fine. Okay, just give me 1 minute. There is so many users on my network, so there might be some streaming issue. Okay, yeah. So related party. So here SA 550 has also played it safe. They told that if the applicable financial reporting framework, if in the applicable financial reporting framework, the term related party has already been defined, follow that definition. If in the applicable financial reporting framework, the term related party is already defined, follow that definition. In case the definition given in the applicable financial reporting framework is incomplete, or the applicable financial reporting framework does not define the term related party, then this standard has given one definition, then follow that definition. So here SF 550 has told one simple thing: if the applicable financial reporting framework has already defined the term related party, follow that definition only. In case if the applicable financial reporting framework did not define the term related party, or they have defined it but it is an incomplete definition, then in SF 550 they have given one definition, we have to follow it. So what is the definition given? So two persons will be considered related if one of them, if a person is having a significant control or influence over other. So if one is controlling the other, then both will be considered as related. Or another entity over which reporting entity has control. Either you are controlling someone or someone is controlling you. Either you are having influence on someone or someone is having influence on you. So that will, you both will be considered as related. Or another entity that is under common control with the reporting entity, either through common ownership, owners who are close family members, or common key management. Say for example, there is a company X Limited. There is another company Y Limited. Now both the companies X Limited and Y Limited are under common control. Sir, how that common control has been arrived at? This common control could have been arrived by way of common ownership. Same group of people are holding the ownership in both the companies, or both the owners of both the companies are belonging to same family, or even they both are under the common key management. Then also you both will be considered as related. So one is having the control other, or someone is having control over you, or both are under common control, then we will call you as related person. And you have to follow this definition only when the definition given in applicable financial reporting is incomplete or not given. And they have given one note point here: entities which are under common control of a state. Basically, if two entities are there under common control of the government, they will not be considered as related unless they share significant transactions or they share the resources. Then, sir, what is the nature of related party transaction? See, generally, if the related party transactions are also happening in the normal course of business, and if the related party transactions are also happening at arm's length price, then we need not worry about it. They might not carry a high risk of material misstatement. So when related party relationships might not carry a high risk of material misstatement, if the related party transactions are in the normal course of business and if they are happening at arm's length price, we need not worry about it. But in some cases, in particularly some circumstances, the risk of material misstatement is very high for related party transactions. In which circumstances, sir? Number one, when related party transactions are operating through complex relationship. There is no direct subsidiary holding relationship. It is a very complex chain of relationship. They have created shell companies and all. There the risk is very high. And also, whatever information system the client is using, that is ineffective information system. Their accounting software is ineffective. Then also risk is very high. Or related party transactions are not conducted under normal market terms and conditions. That means they are conducted under unfair terms and conditions. In these circumstances, risk is higher. Okay, so since we got to know in some circumstances the risk is very high due to related party transactions, now what are your responsibilities as an auditor? As an auditor, what will be your responsibilities? So as an auditor, you need to obtain audit evidence regarding what? Whatever accounting requirements of the related party transactions are there, whatever disclosure requirements of the related party transactions are there as given in the applicable financial reporting framework, whether that accounting and disclosure requirements have been properly given or not, whether related party transactions are properly accounted or not. If I put it into simple terms, whether applicable financial reporting framework has been met or not, I need to obtain evidence. Sir, how can I get that evidence? Very simple. First, you should understand. As an auditor, before you can verify, first you should understand, first you should know what are those accounting and disclosure requirements under applicable financial reporting framework. Then you need to obtain understanding of related party relationships. Then you need to understand which of the related parties your client is having. With that related parties, what transactions have been entered into. And also to conclude finally, whether financial statements give a true and fair view. So this is how you need to obtain audit evidence: by understanding accounting and disclosure requirements, by understanding related party relationships and transactions, and finally arriving at a conclusion whether financial statements give a true and fair view or are they misleading because of related party transactions. And especially when it comes to related party transactions, there are fraud risk factors also. Why? Because of fraud can be easily committed through related party transactions. You have to be pretty cautious about it. And the inherent limitations also will be very much higher in the case of related party transactions. That means the chances of audit's opinion going wrong because of related party transactions is very much higher. Why? Because sometimes management themselves will be unaware. Management themselves will not know who is the related party, who is not the related party. And also related party transactions provide greater opportunity for collusion. So that's why there is always a higher chances of inherent limitations. The impact of inherent limitations is much higher because of related party relationships. So these are your responsibilities. And one more thing, last thing, you have to maintain the professional skepticism. So as an auditor, what are your responsibilities regarding related party transaction? Number one, you need to obtain evidence regarding accounting and disclosure requirements. You have to be careful to the fraud risk factors. Number three, inherent limitations are much greater for related party transactions. Be careful about it. If you want to overcome all this, maintain professional skepticism. And how auditor can verify existence of related party transactions? What and all you can do to verify the related party transactions? So you can inspect the following documents. So what documents you can inspect? You can verify income tax returns. You can verify information submitted to regulatory authorities like SEBI and all. And you can verify shareholder register. You can check the statements of conflict. You can check life insurance policies which are acquired by your client company. You can check the investment register. You can read the contracts and agreements with the key management, and even contracts which are not in ordinary course of business. Mainly they will happen with related parties only. You have to be careful about it. And even you can go through the internal audit reports. Clear? That's all. This much is enough for SA 550. Now we will come to the two important standards, SA 560 and 570, important for descriptive as well as MCQs. So we'll try to spend some time here. So first we will try to understand about subsequent events. What are auditors' responsibilities regarding subsequent events? For that, first we need to understand what is the meaning of subsequent event as per the standards on audit. We all know what is the meaning of subsequent event as per accounting standards or Ind AS. As per Ind AS or accounting standard, they say that subsequent events are those events which are occurring between the date of the financial statements and the date of approval of the financial statements. And those subsequent events, for the accounting purposes, we can divide them into two categories: adjusting events and non-adjusting events. So this is from the accounting perspective, but we are not talking about accounting matters. We are talking about auditors' responsibilities regarding subsequent events. And those responsibilities are given under SA 560. And before we can talk about that subsequent events and auditors' responsibility, first we should know what is the meaning of subsequent event. First, we should know what is the meaning of subsequent event as per SA 560. So the standard defines something like this. Subsequent events are those events which are happening between the date of the financial statements and the date of auditor's report. Those events which are happening between the date of the financial statements and the date of auditor's report, but the fact of that subsequent event came to auditor's knowledge after the date of auditor's report. Some event has taken place between the date of the financial statements and the date of auditor's report. Some event has taken place, but you got to know about that event after you have signed the audit report. Then we call it a subsequent event. See, if you got to know some event, if you got to know about the event before the date of auditor's report only, that is not a subsequent event. There you don't need any guidance. Why? Because if you got to know about the information even before you sign the audit report, whatever action you have to take, that action you can take it through your audit report only. So when we start looking for guidance is when event has taken place before the date of auditor's report, but you got to know about that subsequent event after the date of auditor's report, then you start looking for guidance. Then what will be your responsibilities? That is where the complications are going to come in. And this standard will sort out that responsibilities, what you are supposed to do and all. Okay. And before we talk about auditor's responsibility, this standard says as an auditor, first you need to perform some audit procedures. So as an auditor, you need to perform some audit procedures. See, before you, the management is responsible for identifying subsequent events. Why? Because they are responsible for preparation of financial statements. And while preparing financial statements, they are responsible for complying with the accounting standards. So that's why before auditor, management will identify the subsequent events and do the proper adjustments. Now, as an auditor, you also should perform some audit procedures to determine whether there are any subsequent events. So what audit procedures I need to perform to identify the subsequent events? Like first one, you need to understand what procedures management has followed. Like as I have told before auditor, management is having the primary responsibility to identify subsequent events. So first you should go to the management and ask them, sir, what procedures you have followed for identifying subsequent events? You have to go and ask the management. Number two, then you have to inquire the management and those charged with the governance whether they have found out any subsequent events. Then you read the minutes of the meetings of the board of directors, shareholders, which have especially taken place after the date of the balance sheet. Read the meetings. And even if any interim financial statements are available, read that interim financial statements. And even you try to obtain the written representations from the management. So basically, you should perform these procedures to identify whether any subsequent events have taken place. Now, once if you come across any subsequent events, then what are your responsibilities? Here, there could be two cases. See, generally what will happen, what is the entire process is, first on the date of financial statements. So balance sheet date will come on 31st of March, financial statements will be prepared. Now these financial statements will be approved. Generally, financial statements will be approved by board of directors of the company. So say for example, these financial statements are approved on 15th of April. Then they will be audited and the auditor will sign the audit report. So then what will happen is auditor will sign the audit report. Say for example, he's signing the audit report on 20th of April. Now after signing the audit report, what will happen? These financial statements, audited financial statements, which includes financial statements along with audit report, that will be circulated. That will be made available to the shareholders and third parties. So this is what the process, right? Financial statements will be prepared, they will get approved, then auditor will do the audit, give the audit report, then that financial statements and audit report will be circulated. This is what the entire process. See, sometimes what will happen is you will identify the subsequent event after the date of auditor's report, but before financial statements are circulated. You got to know about subsequent event here only. You got to know about subsequent event by the time you have signed the audit report. You have already signed the audit report, but you got to know about subsequent event before the financial statements are issued. This is case 1. This is where you have some responsibilities to fulfill. Now case 2 is such a case where you got to know about subsequent event after the date of auditor's report and even after issue of the financial statements. You got to know about subsequent events even after the issue of financial statements. That means by the time you got to know about subsequent event, financial statements are already there in the hands of the shareholders. So then what will be your responsibilities? That is covered under case 2. So case 1 says what will be your responsibility if you got to know about subsequent event before the issue of the financial statements. Case 2 says what will be your responsibilities in case if you came to know about subsequent event after the date of issue of the financial statements. You tell me which scenario is more complicated, where you need to worry more. We need to worry more. Our responsibilities will be more in case 2 comparatively with case 1. Okay, so anyhow, let us come back to our responsibilities. We'll talk about what will be auditor's responsibilities under case 1. Then we will try to understand what will be auditor's responsibilities under case 2. So we will talk about what will be auditor's responsibilities under case 1. What about the facts which came to auditor's knowledge before the issue of the financial statements? Somewhat favorable position you are into. So if you got to know about subsequent event before the financial statements are issued, first thing what should happen is you should go and discuss that matter with management. First, you have to go and discuss with the management. You have to go to the management and say them, sir, I got to know about the subsequent event. What are your views on it? Then, as a part of the discussion, determine whether financial statements need amendment. Why? Because that subsequent event could be an adjusting event or could not be an adjusting event. So if you go and discuss with the management, as a part of the discussion, you will get the clarity whether this is an adjusting event. If yes, that requires adjustment. Now, if you have decided that financial statements need amendment because it is an adjusting event, then you inquire the management whether they are ready to amend the financial statements or not. Whether they are ready to amend the financial statements or not, you have to go and inquire with them. Now, there could be two outcomes possible. Number 1, management has agreed to amend the financial statements. Management told, okay, sir, we will amend the financial statements. See, if the management has agreed to amend the financial statements, good scenario, very comfortable scenario. What we will do? We will see whether really they have done the amendments properly or not. Why? Because we can't blindly rely on them. If the management comes to you and say, sir, we have done the amendment of the financial statements, will you blindly believe it? No. So we need to check once whether they have done the amendment properly or not. So you will perform audit procedures relating to amendment and you will try to obtain sufficient and appropriate evidence whether the amendment has been done properly or not. So if you got comfortable that all the evidence has been, all the amendments have been done properly, no need to worry about anything. The old audit report, whatever you have given, that will remain valid except one change. What is that change is you have to change the date. No impact on the opinion, but you will be required to change the date. Why? Because you have already given the audit report. Say for example, if you come back to this example, you have already given the audit report on 20th of April. Now the management amended. Say for example, on 25th of April, management amended the financial statements. Now these amended financial statements will be approved once again. These amended financial statements will be approved once again. Say for example, they are approved on 26th of April. But your old audit report will remain valid. But you have already given that audit report on 20th of April, no. So here the date of audit report is before the date of approval of the financial statements, which should not be a typical scenario. So that's why what you will do is the old audit report will remain all valid. Just you will change the date. What you will do is you will also change the date to 26th of April and then give the audit report. Understood? So this is what your responsibility in case if the management amends the financial statements. Will perform audit procedures, obtain evidence whether amendment is properly done or not. There will be no impact on the opinion, but we'll do one change. What we will do, we'll change the date. Sir, what if management does not amend the financial statements? This is a problematic scenario. You have got to know about subsequent event. You determine that that event needs adjustment in the financial statements. I requested the management to amend the financial statements. Management told get lost will not amend the financial statements. Now what we should do? So if the management does not amend the financial statements, here also there could be two scenarios. Scenario number one, you have signed the audit report. You have not yet given it to the management. You signed the report. You thought, for example, today you signed the report. Tomorrow you wanted to give it to the management. But before you can give to the management, you got to know about the subsequent event. I requested the management to amend it, but they are not amending. But since you have not yet given the audit report to the management, the audit report is still with you, happy, no issue, cancel the old audit report, throw it in the dustbin, give a new audit report containing a modified opinion. So if audit report is not yet given to the management, modify the opinion and give the audit report. In case if audit report is already given to the management, if audit report is already given to the management, now here there is a problem. If the management has already given the audit, if auditor signed the audit report and that audit report has already been given to the management, now there is a problem. So now what you should do? Now what you should do is first you have to go and instruct the management not to circulate the audit report. Go to the management and say them, sir, whatever audit report I have given to you, don't circulate it. Why? Because you did not amend the financial statements. No, I have to amend my audit report. I will give a modified opinion, give you a new audit report, then only circulate. Please don't circulate the audit report. Go and instruct the management. See, even after instruction also, management did not listen to you. They have circulated it. Then the standard says auditor should take appropriate action to stop the people from relying on that auditor's report. If without listening to your instructions, even after you give the instructions also, management has circulated the audit report, now you should take appropriate action to stop the reliance. Sir, what could be the appropriate action? It is completely your professional judgment. Like you can give a newspaper advertisement, you can give a update to the stock exchange, whatever it is you can do, take appropriate action. And finally, give a new audit report containing a modified opinion. So this is what your responsibilities are in case if you got to know about subsequent event before the financial statements are issued. Now comes a more problematic scenario. What will be your responsibilities in case if you got to know about subsequent event, but by the time you got to know about the subsequent event, financial statements are already issued? Then what you are supposed to do? Then what am I supposed to do is, so in case if I got to know about subsequent event after the financial statements are issued, then also the same things. First I have to discuss the matter with the management. As a part of the discussion, determine whether financial statements need amendment and inquire whether management is ready to amend the financial statements or not. And in case if you have decided that financial statements need amendment, now first you should go and ask the management to take appropriate action to stop the reliance on the reported financial statements. Why? Because the financial statements have already reached the shareholders. No. So in case if you have decided that financial statements need amendment, just go to the management, ask them, sir, take some appropriate action to stop the people from relying on the auditor's report. Like give a newspaper advertisement or give a announcement on the website, whatever it is, ask the management to stop the people from relying on the audit report and the financial statements. In case if the management doesn't take appropriate action, then the standard says auditor himself has to take the action. So whatever it is, either the management or auditor, someone has to take the action to stop the people from relying on the auditor's report. Now, once someone has taken the action to stop the people from audit report, now once again same, if the management has agreed to amend the financial statements, here also I will perform audit procedures related to amendment. I will try to obtain sufficient and appropriate audit evidence. I will give a new audit report. Now the standard will say give a new audit report. And in that audit report, I will give unmodified opinion only. Why? Because management has amended the financial statements. But now you are giving a new audit report and the shareholders already have one audit report. Now if you are giving new audit report and shareholders already have one old audit report and also the shareholder will have one old copy of the financial statements, now you are sending a new copy of the financial statements, they might get confused. So that's why what the standard has told is in that new report, either use an emphasis of matter or other matter paragraph to highlight that effect of the amendment so that shareholders will not have confusion. So it will not have impact on the opinion. Just in the new audit report, I will include either an emphasis or other matter paragraph. On the other hand, if the management doesn't agree to amend the financial statements, Then what I should do, I will give a new audit report which contains a modified opinion. Either a qualified or adverse opinion will be there. So I will give a new modified opinion and I will explain the reason for giving that modified opinion in my basis for modified opinion paragraph. Here there is no requirement to use either emphasis or other matter paragraph. You should not use it. Why? Because reason anyhow you are explaining in the basis for modified opinion paragraph. Perfect. Right. So this is what regarding the standard SA 560. Now we will come to the next important standard, which is SA 570, talking about going concern. Talking about going concern. As we all are aware, going concern is one of the fundamental accounting assumption. And when it comes to the going concern assumption, if someone tries to play with the going concern assumption, if the management tries to tamper with the going concern assumption, it will altogether have a deadly impact on the financial statements. It will cause a pervasive effect of the misstatement on the financial statements. It will cause a pervasive effect on the financial statements. So that's why, since going concern is one of the very much fundamental accounting assumption, the standard, a dedicated standard has been given to assist the auditor to help him to obtain sufficient and appropriate audit evidence regarding going concern. But first of all, you tell me, it is whose responsibility to make an assessment regarding going concern? First of all, what do you mean by going concern? Going concern means it is an assumption that entity will continue for the foreseeable future. Foreseeable future in the sense, I can say in the next 1 year. So the assumption that entity will continue for the foreseeable future, that is for the next 1 year, entity will continue. There is no requirement for the entity to get closed down. That assumption, I call it as going concern assumption. Now, who is responsible for making that assessment? Whether entity will be able to continue for the coming 1 year, or will they, or going concern assumption is valid for them, or going concern assumption is invalid for them. Who is responsible for making assessment? So the primary responsibility for making assessment regarding going concern is with the management. It is management who is responsible for making assessment regarding going concern, not auditor. So management has to do, management is responsible for making an assessment regarding going concern. And how they will do that assessment, whether they will continue for the next 1 year or not, how they will do that assessment? Will they toss a coin and say heads comes going concern valid, tails comes going concern invalid? Will they do it? No. So when the management is making assessment regarding their ability to continue as a going concern, they will keep various factors in mind. Like they will consider the factors of size and complexity of the entity. What is the nature and condition of the business? Are there any uncertainties like litigations and claims? And also external factors like changes in the laws and regulations. So they will consider all these factors, then they will make a decision whether entity's going concern is valid or not. Okay, management will make an assessment regarding going concern. Then what is auditor's responsibility? Agreed, management will make an assessment regarding going concern. But what is auditor's responsibility? So in order to know what is auditor's responsibility, SA 570 objectives paragraph we have to read. So objectives of SA 570 paragraph will actually say what is the auditor's responsibility. So SA 570 says that the responsibility of the auditor is to obtain sufficient and appropriate evidence regarding the appropriateness of management's assessment. Management will make an assessment regarding going concern. Now, whatever assessment management has made regarding going concern, whether that assessment is appropriate or not, regarding that, I need to obtain sufficient and appropriate evidence. So that's what they say here, to obtain sufficient and appropriate audit evidence regarding appropriateness of management's use of going concern assumption. So whatever assessment management has made, for that I need to obtain audit evidence. Now, how will I obtain that audit evidence? I will try to obtain that audit evidence by performing audit procedures. Definitely right. So if I want to obtain audit evidence, I need to perform audit procedures. Sir, what audit procedures I need to perform to obtain audit evidence regarding appropriateness of management's assessment of going concern? That audit procedures are given in the same standard. We need not go and look anywhere. In the same standard, they have told what audit procedures you have to perform. And by performing that audit procedures, you need to determine, is there any material uncertainty relating to going concern? Depending on that audit procedures, we need to determine, is there any material uncertainty relating to going concern? I will talk about that material uncertainty in a while now. And then finally, you have to report it in accordance with the standards on audit. Whatever your findings are there, all those findings are required to be reported as per the requirements of the standard. So 3 responsibilities of the auditor as per SA 570 regarding going concern. Number 1, obtain sufficient and appropriate audit evidence regarding the management's assessment of appropriateness of management's assessment of going concern, and determine on the basis of evidence whether any material uncertainty exists, and to report in accordance with the standard. So now you will perform procedures. So as I've told, the standard is asking you to perform some procedures. You will perform all that audit procedures. I will say I will come to that later. What audit procedures we will perform, we will come to that later. Now, after performing all the audit procedures, whatever have been given in the standard, there could be multiple options which could be possible. There could be different outcomes which could be possible. So after performing all the audit procedures, I have arrived at a conclusion that going concern is valid, going concern is appropriate. Entity will continue for the foreseeable future. There is no requirement to wind up the company. Or other case which could be possible is going concern is inappropriate. I have got perfect evidence that going concern is inappropriate. Entity will not continue for the next 1 year. Either the financial position is very bad or they're going through pending cases. So whatever it is, I am very much certain I have evidence that going concern is inappropriate. Entity will get closed down in the next 1 year. Or there could be one more typical scenario. I might come across a situation where I find that there is a material uncertainty relating to going concern. Material uncertainty relating to going concern. That means depending on procedures whatever I have performed, I am able to conclude that whether entity will continue in the next 1 year or not, that is uncertain. That means we can't say it with clarity. That depends on some facts and circumstances which are beyond the control of the management, beyond the control of the auditor. Like for example, a company might be going through pending case. If the company wins the case, they will stay in the business. If the company loses the case, they will be thrown out of the business. So whether entity will continue for the coming 1 year or not, that is depending on, that is uncertain on the outcome of that litigation. This typical scenario we call it as material uncertainty relating to going concern. So three outcomes could be possible. You might come to a conclusion that going concern is appropriate, entity will continue for the future, there is no requirement to close down. Or you might come to a conclusion going concern is inappropriate, which says that entity will not continue for the next 1 year, it will compulsorily get closed down. Or you might come across a confusing state where you believe that there is a material uncertainty relating to going concern. So in each of these cases, what will be your responsibility? See, if the going concern is appropriate, then there is no report, then there is no specific requirement. We will give an unmodified opinion. Here, nothing requires a discussion. But the other two cases require discussion. So, case 2, going concern is inappropriate. You have obtained audit evidence that entity will not continue for the next 1 year. You have obtained evidence that entity will not continue for the next 1 year. Then what you will do? The standard says if you come to the conclusion that going concern is inappropriate for the entity, the next thing we need to check is whether adequate disclosure has been given in the financial statements or no adequate disclosure is given in the financial statements. If the going concern is inappropriate, the next thing what we need to check before we come to the opinion, we need to check is the entity has made appropriate disclosure in the financial statements or adequate disclosure is not given in the financial statements. Sir, what do you mean by giving adequate disclosure? Giving adequate disclosure means entity has accepted to the fact that yes, their going concern is invalid. They have valued all their assets and liabilities on liquidation basis, and that difference between the carrying values and liquidation value has been taken to the statement of P&L, and even in the notes to accounts they have clearly explained that going concern is invalid for them, they will not continue. That is what the meaning of giving proper disclosure. That is what the meaning of giving a what? Proper disclosure. That means management has valued all their assets and liabilities on liquidation basis, as if they sell their assets on the balance sheet, what value they will realize, that value they have determined, and the differential between the carrying value and this realizable value they have taken it to the statement of P&L, and clearly in the notes to accounts they have explained that they will not continue for the next 1 year. So that is what the meaning of giving adequate disclosure. See, if the management has given adequate disclosure, you tell me in that case, are the financial statements misleading? No, financial statements are not misleading. Here the financial statements are genuinely presented. So which opinion I should give? As usual, I will give unmodified opinion because the financial statements are not misleading. But I want to highlight this information somewhere in my auditor's report. Entity has done everything correctly, but I felt that this information is very fundamental to users' understanding. People might not go and read that information. I felt it is better if I highlight it somewhere in the auditor's report. Then what the standard has told is use the emphasis of matter paragraph and highlight that information. Since the information is already presented or disclosed in the financial statements, you want to bring it to the user's attention because it is very fundamental to users' understanding. So you can highlight it in the emphasis of matter. On the other hand, if you decided that going concern is inappropriate and management did not give adequate disclosure, what do you mean? What do you mean by management not giving adequate disclosure? What do you mean by management not giving adequate disclosure? Is there is the management is continuing even though the going concern assumption is inappropriate, the management still continues to show its assets on historical cost basis. So that is a case of giving not adequate disclosure. Here the standard has told you to go to the extreme and directly give an adverse opinion. Don't look any other way. Directly give the adverse opinion. Why? Because that misstatement is not just material. That misstatement is material as well as pervasive. So no need to have any second thought. Directly go ahead and give the adverse opinion. Right? So this is what regarding when going concern is inappropriate. Now there could be one more case. What is that one more case? The auditor has concluded that there is a material uncertainty. That means whether entity will be able to continue for the next 1 year or will not continue. That is highly uncertain on some events and circumstances. See, if that is the case, here also what we need to check is whether that adequate disclosure has been given for that material uncertainty or there is no adequate disclosure given for material uncertainty. If adequate disclosure has been given for material uncertainty, if proper disclosure has been given in the financial statements, that means management in the notes to accounts, they have clearly explained so and so uncertainty we are facing, whether we will continue or not, it is depending on the outcome of the pending case, that they have clearly explained. So if they have given adequate disclosure, no need to modify the opinion, we can comfortably give an unmodified opinion. But here also, even though, don't you think, even though the management has explained, adequately disclosed that information in the financial statements, don't you think it is very much fundamental to users' understanding of the financial statements? Yes. Generally, what we should have done, if you want to highlight it, we should have used it a emphasis of matter paragraph and we should have highlighted it. But here the standard has specifically told, don't use emphasis of matter paragraph, use material uncertainty relating to going concern paragraph. Use a separate paragraph. In the case of material uncertainty, if you want to highlight it in the auditor's report, don't highlight it under emphasis of matter paragraph. Instead, use a separate paragraph with the heading material uncertainty relating to going concern, and in that paragraph you want to highlight whatever you wanted to highlight it. Next, sir, what if there is no adequate disclosure? So here straightforward, if there is no adequate disclosure, in that case financial statements are misleading. You have to give a modified opinion, and what kind of modification? Either qualified or adverse depending on materiality and pervasiveness, and the reason anyhow you will explain in basis for modified opinion paragraph. In this case there is no requirement to use material uncertainty relating to going concern paragraph, because the reason anyhow you are explaining it in the basis for modified opinion paragraph. And there could be some cases where management will not share their assessment only. So as I have just now mentioned, as an auditor, you need to obtain evidence whether assessment of the management is appropriate or not. So I asked the management, sir, going concern valid or not? Management told, yes sir, going concern is valid. Sir, did you make an assessment? Management told, yes sir, we did the assessment. I asked them, share that assessment with me. As an auditor, I asked them, share that assessment with me so that I will verify and obtain evidence whether this going concern assumption, whatever assessment that you have done regarding going concern, is it appropriate or not? I will have a look at it. I will have a look at it and try to obtain the evidence. But the management is not sharing that assessment with you to obtain the evidence. So this is a typical case of non-availability of the audit evidence. In that case, either you have to give a qualified opinion or a disclaimer of opinion, because this is a case of non-availability of audit evidence. Understood? So once you have performed audit procedures, depending on your findings, these will be the impact on reporting. But we did not see yet what are the procedures which we are required to perform. See, after performing the procedures, depending on your findings, these reporting requirements will come. Like once you have performed audit procedures, you will have some findings, then these findings will result into these reporting requirements. But we did not see yet what are that procedures which you are required to perform. So that procedures we will try to address now. So what are that procedures you are required to perform? So here also we have divided the procedures into two categories. One is risk assessment procedure. Basically, first we need to perform the procedures to identify is there any risk of material misstatement related to going concern. Sir, how can I identify that? Let us see. The auditor shall consider whether there are any events or conditions exist that may cast a doubt on entity's ability to continue as a going concern. So as an auditor, first you need to evaluate, first you need to identify, is there any event or circumstance that is creating a doubt regarding going concern? Sir, what are that examples of events or circumstances which create a doubt regarding going concern? That also standard itself has told it. And that indicators, that events or conditions which create a doubt regarding going concern, that have been divided into three categories under SA 570. So what are the three categories? Financial indicators, operating indicators, and other indicators. Sir, what are financial indicators? Like net liability position. The company is always having net liability. Borrowings are approaching maturity, but your client has no prospects to repay it. Continuous negative cash flows. Customers are withdrawing withdrawal of financial support by the suppliers, and financial ratios are very bad. Don't you think if you come across these circumstances, you will get a doubt regarding ability to continue as going concern or not? Yes. Similarly, some operating indicators like management itself wants to liquidate, or some key management has left the company, labor difficulties, they are not able to find the labor, and shortage of important supplies. The raw material which you want for your operations is in huge shortage, or altogether a successful competitor has come who is taking your market share. And other indicators like non-compliances with the laws, pending cases, uninsured catastrophes, or changes in the laws and regulations. So basically, I will try to identify whether any of these indicators are present, by which create a doubt regarding going concern. Sir, how will I get to know whether these events are there or not? Simply by going and inquiring with the management. So, and by inquiring the management, in case if you got to know about any such event or condition which cast a doubt regarding going concern, then you should perform the further audit procedures. If no such event has been identified, you can stop yourself with risk assessment procedures. But in case if you identify any such event or condition, then you need to perform the further audit procedures. Sir, now what are that further audit procedures? Request the management to make the assessment. If not yet done, if the management has not yet made an assessment regarding going concern, ask the management to do the assessment. Sit with the management, discuss what are the plans for their future, analyze the cash flow forecast. Generally they will prepare the forecast, analyze that forecast, cash flow forecast, what assumptions they have used, whether that assumptions are appropriate or not. Request a written representation, then analyze the profits, cash flows, etc. Read the latest interim financial statements, inquire the legal counsel, inspect the loan agreements, and even read the minutes of the board of directors meeting. So all this further audit procedures you will perform. Then you will have your observations, and depending on your observations, we are going to fulfill this reporting requirements. Understood? So this is what regarding SA 570. So we have completed SA 570 also. Now we are left with only one more standard in the 500 series, which is SA 580, talking about written representations. Just talking about what? Written representations. So let us try to discuss now this written representations related standard also. Right. So this also relatively important from MCQ's perspective. Very rarely they ask a descriptive question from here. But anyhow, we'll try to give a summary. If at all MCQs gets tested, we should be in a position to answer it. So we'll try to quickly cover this summary. So written representation. So first of all, what is the meaning of the written representation? They say that the meaning of the written representation is the written statement which is obtained by the auditor. The written statement which is obtained by the auditor from whom? From management. See, when I say external confirmation, that is a written confirmation obtained by the auditor from a third party. But when I say written representation, that is a written statement which is obtained by the auditor from the management. For what? With what purpose? To confirm certain matters or to support the other evidences. So in order to confirm certain matters or to support the other evidences which you have gathered, you get a written statement from the management of the company. That written statements, we are going to call them as written representations. Like if you pay attention now, till now, so many standards we have discussed, and if you pay close attention, in each and every standard, in many standards, they have asked you to obtain written representation regarding certain matters. So those are nothing but written statements which you as an auditor obtaining to confirm certain matters or to obtain the extra evidences. Now, sir, whatever written statements which I am getting from the management to confirm certain activities, is that an audit evidence? Yes, that is an audit evidence, but the problem is it is only a supporting audit evidence. They do not provide sufficient and appropriate audit evidence on their own. So if you get the written confirmation from the management, yes, to some extent it is an evidence, but it is in the nature of supporting evidence only. You written representation cannot provide evidence on their own. That means you can't completely rely only on written representation for the purpose of evidences. So that is just a supporting evidence, that is not a evidence on its own. Why? Because if the standard has told you to rely only on written representation, my work will become very, very easy. You will not imagine that my work will become damn easy. Why? Because if I can use written representation only as a audit evidence, I will go to the management, ask the management to give me written confirmation that they comply with applicable financial reporting framework and financial statements are free from material misstatements, and I will sign the audit report and come back. But that is not the case, right? So that's why written representation do not provide evidence on their own. Now, what are the objectives of the auditor? Sir, regarding which matters I need to obtain written representation? Number one, every auditor must compulsorily get a written representation from the management that the management has fulfilled the responsibility for preparation of financial statements and they have completely provided the information to the auditor. This is must. Every auditor must get from every company this written representation that management has fulfilled the responsibility for preparation of financial statements and they have completely provided the information to the auditor. They did not hide any information from the auditor. Confirming these two matters, every auditor for every entity he must get the written representation. And also if there is any requirement of other standard, like for example in SA 570, just now as we have completed, SA 570 will ask the auditor to get the written representation from the management regarding going concern. There also you have to get it. SA 560 also they have told you need to obtain written representation from the management regarding subsequent events. That also you have to obtain. So like that, if there is any requirement from the relevant standard, you can obtain the written representation. And in all other cases, it is up to your choice in which matter you will get written representation, in which matter you will not get written representation. And whatever written representations you have got, you have to respond appropriately. And sometimes management, you request the written representation from the management, but the management is not providing the written representation, then also you need to take appropriate action. Then also you have to respond appropriately. So whether management is giving the requested written representation, respond appropriately. Management is not providing the written representation, then also you have to respond appropriately. So these are the objectives of the auditor. Next, date and period covered by written representation. So most important thing here, the date of written representation shall not be later than the date of auditor's report. The date of written representation shall not be later than the date of auditor's report. Why? Because written representation is also a kind of audit evidence. Written representation is also a kind of audit evidence, and the process is first you will obtain audit evidence, then you will give the opinion. So that's why the date of written representation can never be later than the date of auditor's report. It should be either on or before the date of auditor's report. Next, and one more thing, the date of written representation should be as close as possible to the auditor's report. The date of written representation should be as close as possible to the auditor's report. So if you download the question bank, in the question bank there is one interesting question in the chapter. So just download my question bank, even I have kept it on the website also. So you can download the website and go through the questions of the standards on auditing chapter. I have kept some interesting questions there. There will be one question where they will say the date of written representation must be as far as possible close to the date of auditor's report. So one interesting question will be there. I would suggest you to go and refer it. Next, fine. Management from whom written representations are requested. See, when I say management is a very broader term. There will be many people who are falling under the management definition. So, but from whom I will try to obtain written representation. I will not go to each and every management person and ask the written representation. Generally, I request written representation from those people who are involved in the financial statement process, or from whom I expect that they have a reasonable knowledge regarding the financial statements and items. From that person I can expect written representation. Generally like CEO of the company, CFO of the company, or if audit committee is there, with the audit committee, generally with these people I ask the written representation. I do believe that these people, we generally believe that these people will have all the requested information. But sometimes what will happen is, regarding one matter I need some written representation. Like for example, I need written representation regarding accounting estimate. Management has created a gratuity provision. I want the management to give a written representation regarding the gratuity provision. But the management did not create that provision. I went to the CFO and asked, but CFO was not involved in the provision. Some actuary has done it. Can the CFO say, sir, I don't know about this gratuity provision. That's why I will not provide written representation. Can he say that? No. The standard says that you go to the concerned management, ask the written representation. But if the concerned management does not have the required information, it is his responsibility to go to the concerned person in the organization, get the required information, and then provide the written representation to the auditor. They simply can't wash off their hands saying that I don't have information, I will not give written representation. They can't say it. It is their responsibility to go to the concerned person, get the required information, and provide the written confirmation to the auditor. Okay, so that's what they say. Sometimes management may be required to make inquiries of others within the entity to obtain the relevant information. Like they can go to actuary, legal expert, staff engineer. These are just examples. If they don't have required information, they go to these kind of persons, get the required information, provide the confirmation to the auditor. Next, in some cases, you might be required to obtain written representation from the management to reconfirm your responsibilities. Sir, when you will get when you will get a written representation to reconfirm. Reconfirm means what? Confirming once again. That means initially you got a confirmation regarding the management responsibilities and all. But in some cases, during the course of the audit, it might be necessary for you to reconfirm the management responsibilities by getting written representation once again. When, sir? When those who signed the terms of engagements have changed. Basically, board of directors have changed. Those people who signed the engagement letter, those are not the people who are now in charge of the company. So then you might be required to get the engagement. Now you might be required to get the written representation once again from the new management. Or terms of engagement are prepared in the previous year. You have prepared the terms of engagement in the last year. Now you want to change the terms. Get the confirmation once again. Or management misunderstand its responsibilities. Initially, management gave a written representation that they are accepting all the responsibilities, but later I realized that management misunderstood their responsibilities and gave the confirmation. So just go and explain to them clearly, sort out that misunderstanding, and get the written representation once again to confirm that responsibilities. And if at all any circumstances have changed, because of the change in circumstances also, you might be required to obtain a written representation once again. And last two paragraphs we have. Sometimes management will give written representation, but I will have a doubt regarding its reliability. Management will give a written representation, but I will have a doubt regarding its reliability. You tell me generally when I will have a doubt regarding reliability of reliability of written representation. When I have a doubt regarding integrity, when I have a doubt about integrity, I felt that management is not honest. Or when I have doubt regarding competence, I felt that management is not capable. They don't have a required knowledge of financial statements and all. So then obviously I will have a doubt regarding reliability of financial information, reliability of written representation. So when you have concerns about integrity, competence and ethical values of the management, in those cases, I will have a doubt regarding reliability of written representation. And especially when written representation management has given and evidence you have gathered when both are inconsistent, this is a very much problematic area. So if you obtain written representation from the management and you have obtained some evidence regarding that item, whatever management is confirming and whatever evidence I have got, there is a inconsistency. I need to resolve this matter. Auditor shall resolve this matter. Is written representation only wrong, or the evidence which I have got is wrong? I have to evaluate. See, if the evidence you have got is wrong, okay, I will perform extra procedures and get the evidence. But if I have concluded that no, evidence is correct only, but written representation is only wrong, then I need to reassess my risk of material misstatement, consider the implications on my auditor's opinion. Even here, the standard has told you to go to the extreme and give a disclaimer of opinion. Even the standard has asked you to go and give a disclaimer of opinion if you have finally decided that written representations are not reliable. So if the auditor determines that written representations are not reliable, then the auditor shall consider even modifying the opinion. Generally, disclaimer he will give you. Extreme you have to take. Next, requested written representation not provided. See, in the previous case, you asked for written representation, management provided, but they are not reliable. But now this paragraph says you asked for written representation from the management, but the management is not providing the written representation only. Then what I should do? Then you have to go and discuss the matter with the management, reevaluate the integrity of the management, that means reassess the integrity of the management, and even consider modifying the opinion. If required, consider modifying your opinion. So this is what the last standard from 500 series. With this, we have even completed SA 580 also. So all 500 series of the standards we have completed. Clear? Comfortable everyone? Right. So now what we will do is we will discuss 200 series of the standards. We are going to discuss now 200 series of the standards. So 240, 250, 260 and 299 we have very simple and easy standards only. And here descriptive questions are going to come. Very important from the examination perspective. 240, 250, 260 and 299. So these are four standards we'll try to quickly cover. Right. So we have successfully completed today 3 hours of stream. 3 hours of marathon we have completed. Yeah, we are making a good progress. So still I will continue for 1 more hour. Yes, I will continue for 1 more hour. So I will complete 200 series of the standards, and also I will try to complete audit strategy, planning and execution, like that one topic we have. Relatively small topic, easier also, will not take much of a time. Hardly it will take some 30 to 45 minutes. So that also I will try to complete it. But before that we have to complete this 200 series of the standards. So let us try to do it. So the auditor's responsibilities relating to fraud. SA 240 is the standard which is talking about auditor's responsibilities relating to the fraud. So whenever you are conducting audit of financial statements, as a part of that audit of financial statements, sometimes you might be coming across a fraud. And as we all are aware, misstatement can happen because of two reasons. Misstatement can happen because of fraud also. Misstatement can happen because of error also. See, if the misstatement is happening because of error, it is not that much troubling. It is not something which you have to worry about, right? But if the misstatement is happening because of fraud, this is something which is of very much a serious concern. Why? Because when someone has committed a fraud, they have done it intentionally with a manipulative intent, and they are trying to cheat the company with a malicious intention. So that is going to be a very major concern which you have to get worried about. So that's why, if the fraud, regarding fraud, we have so many extra procedures we need to perform, we have so many responsibilities to fulfill, and even SA 240 has given a detailed guidance. They will explain you what and all are the different methods in which fraud will be perpetrated, what and all are different ways, what and all different indicators. So like that, many things the standard will try to guidance here. But one caution I would like to give here: see, when the standard is trying to tell you the techniques for committing fraud, indicators of the fraud and all, the intention is not that you will become so-called scammer or fraudster after in your future. They are teaching you all this so that you will be able to identify it. They're teaching you all this so that you will be able to identify it, not that you will go and become a scammer or fraudster. Clear? So that has been the whole intention of this standard. So let us try to get into the details. First of all, what is the definition of the fraud? So as we all are aware, we have read when we were kids, actually in the CA inter level itself, we would have read this definition of the fraud. So how to define the fraud? Fraud is something which is an intentional act. It is always done with a intention. So fraud will not happen unintentionally. Someone will do it intentionally, and it could be done by one individual or more than one individual. Either one individual can do it, or more than one individual can do it. And those individuals who are committing this fraud, they can be from the management, they can be from those charged with governance, and even they can be from employees or third parties, and all of them can collude also. So someone from management, someone from those charged with governance, someone from employees, or someone, a third party outside of the organization, anybody, either they all might collude with each other and commit a fraud like the PNB scam also. So anybody can do it, and it always involves the use of deception. Deception means what? Cheating. By committing the fraud, you are actually cheating the organization. Now, why you are using that deception? What is the ultimate purpose of committing that fraud? To obtain an unjust or illegal advantage. So to get some advantage which is unjust, for which you are not entitled to, or to get some advantage which is not legal for you. So that is what the whole purpose of the fraud. So if you rewrite the definition of the fraud, this is how the definition will look like. So fraud is an intentional act committed by one or more individuals. That individuals could be among management, those charged with governance, employees or third parties, and it always involves the use of deception. And why we are doing that is to obtain an unjust or illegal advantage. Okay. Now I will say, sir, who is responsible for preventing and detecting the frauds in the organization? Say for example, there is a company X Limited. You are a chartered accountant appointed as auditor of this company. Now in this company, it is whose responsibility for prevention and detection of the frauds? So the primary responsibility for the prevention and detection of the frauds is always going to rest with the management, because management are the people who are running the business. Management are the people whom the people have trusted and invested their money in the entity. So management is having the primary responsibility to prevent and detect the frauds in the organization. So then what about auditor's responsibility? Then what about auditor's responsibility? See, the main responsibility of the auditor, even the standards on auditing also says, the primary responsibility of the auditor is to obtain reasonable assurance whether financial statements are free from material misstatements because of error or fraud. And because there are, and even though he can obtain reasonable assurance, but still we know that the process of audit is suffering from some inherent limitations, because of which no matter how effectively you do the audit, still some fraud might be and still some misstatements might be undetected. Does that mean will the auditor not be held responsible for not detecting the fraud? Will the auditor be not responsible for not detecting the fraud? Which means if the auditor has committed the audit but he was unable to detect the fraud, will he not be punished? Will he be spared just like that? No. Will that mean he will always be punished for not detecting the fraud? No, that is also not. So whether auditor will be punished or auditor will not be punished, it all depends on whether auditor has behaved in a proper manner or not. So the standard says that the liability of a auditor for failure to detect the fraud, it exists only when such failure is clearly due to not exercising reasonable care and skill. That means if you behaved in a negligent manner, if you did not do the audit in a careful manner, if you did not exercise the proper skill while doing the audit, that's why you are not able to identify the fraud, then that failure is purely because of your mistake and you will have to face the consequences. Then only you will be held responsible. But anyhow, whether auditor will be able to detect a fraud or will not be able to detect a fraud, that all depends on multiple factors. Like it just will not depend on ability of the auditor, it depends on other factors, like it depends on the skillfulness of the perpetrator, the person whoever is committing the fraud. It depends on his skill. If he is more skillful, very difficult to detect a fraud. If he is not that skillful, easier to detect a fraud. It also depends on frequency, with what frequency the fraud is committed. If it is getting committed frequently, somewhere it will come into our sample and we will catch him. If it is just committed once in a while, it might come into our sample, might not come into our sample. It also depends on degree of collusion. Higher the collusion, more difficult it will be to detect. It also depends on size of the amounts getting manipulated. If the fraud is committed in a very big figure, easier to detect. If the fraud is committed in small negligible amounts, difficult to detect. It also depends on the seniority of the person whoever is committing the fraud. So whatever it is, it depends on all the factors, but whether auditor will be held responsible or not, it depends on whether he has exercised reasonable care and skill or not. That he has to prove it with the help of audit documentation. Clear? Next, the frauds can be broadly divided into two categories. One is fraudulent financial reporting and the other one is misappropriation of assets. See, this fraudulent financial reporting is having other name. We also call it as a manipulation of accounts. What we can also call it, manipulation of accounts also we call it. The name itself says you are trying to show a wrong picture through the financial statements. The fraud in which the management is trying to convey a wrong picture to the financial statements to mislead the users to affect their investment decisions, that kind of fraud we call it as fraudulent financial reporting. The name itself says financial reporting. It is a process of preparation and presentation of financial statements. Fraudulent financial reporting, that means you are doing that financial reporting in a fraudulent manner, in a wrong manner, to cheat the others. You are doing the financial reporting, so that fraud we call it as fraudulent financial reporting. So it involves intentional misstatements. Either that could be omission, you are omitting some information, or of amounts or disclosures to deceive financial statement users. You are cheating the users of the financial statements. Okay, and one more thing here, when I say fraudulent financial reporting, it cannot happen unless the management involves. Without the management involvement, fraudulent financial reporting can't happen. If the fraudulent financial reporting is happening, there definitely management is involved. On the other hand, we have one more category of the fraud, which is misappropriation of the assets. Here what will happen is, here there will be damage. It is such a kind of fraud where entities' assets will be stolen, lost, damaged, or theft is happening. So it involves the theft of the entity's assets, and generally this misappropriation of assets, we expect the low level employees to commit it, not the top level management. We don't expect from them. So we expect the low level employees to commit these kind of frauds. Okay, so now next thing they say, see, you take any kind of fraud, whether you take misappropriation of assets or you take fraudulent financial reporting, for any fraud to take place, there must be three things. For any fraud to take place, either fraudulent financial reporting or misappropriation of assets, for any fraud to happen, there must be three scenarios. There must be three things present. Number one is incentive or pressure to commit fraud. It all starts with the incentive. It all starts with a pressure. If the management is trying to show a wrong picture through the financial statements, might be they are under a pressure to do it, or they find some incentive in doing it. If an employee is stealing the assets of the company, he is doing it because he might be under some pressure, or he is finding some incentive in doing it. So the starting point of any fraud to happen, either fraudulent financial reporting or misappropriation of assets, is incentive. It all starts with a incentive or pressure. But having a incentive or pressure alone will not be enough. Even there should be an opportunity to commit the fraud. What also should be there? Opportunity also should be there, like some weakness in the internal control, some lapse in the organization, some lapse in the process, some opportunity should be there. That should make the fraud possible. So first it should have incentive or pressure, then it should be supported by an opportunity. And having the pressure and opportunity alone will not be enough. Even rationalization, attitude, this third aspect talks about attitude. The person who wants to commit a fraud, or the management who wants to commit fraudulent financial reporting, they should have such an attitude where they will be able to rationalize committing the fraud. That means they should be able to justify committing the fraud. The management should be having such an attitude where they will be able to justify. That means even after committing the fraud also, they will be able to rationalize it. Such an attitude also you should have. So you take any fraud, either misappropriation or fraudulent financial reporting. For any fraud to take place, three things must be present. Number one, there should be an incentive or pressure to commit a fraud. Number two, there should be an opportunity to commit a fraud. Number three, there should be an attitude to rationalize the fraudulent acts. So like this, any fraud to happen, these three things should be there. Done. Then they elaborate here. As I have told, this standard will also tell you what are the various techniques for committing the fraud. No, so here they are telling the techniques. Like first, I will address here how misappropriation of assets can be done. How generally employees will commit the misappropriation of assets. So generally what they will do is they will embezzle the receipts. That means they will not account for the receipts. Like for example, one cashier is there, he is doing the cash sales, but some cash sales is not recording in the books of accounts. Or what they can do is they can steal the fixed assets or intellectual property. Even intellectual property is also an asset. For a pharmaceutical company, a formula for a new drug is a intellectual property. Even that also can be stolen. That is also misappropriation of assets. Or causing an entity to pay for goods and services not received. Causing an entity to pay for goods and services which are not received. That means submitting fake bills, fake expenses, booking and spending the money, or using an entity's assets for personal purposes. Company's assets are getting used for personal purposes. This is also one way of accomplishing misappropriation of assets. So misappropriation of assets can be accomplished by entities in these different ways. Similarly, how fraudulent financial reporting can be committed, for that also they are giving the techniques. Like if you see here, manipulation, they can do manipulation. Falsification, like they can do forgeries and all. And even alteration of accounting records or supporting documentation. Or misrepresentation, wrongly presenting the information. Intentional omission, intentionally they are omitting the information from the financial statements. Or intentionally they might misapply the accounting principles, like treating capital as revenue, revenue as capital, current assets are non-current, non-current as current. So they can intentionally misapply the accounting policies. Or sometimes management themselves will override the internal controls to commit the fraudulent financial reporting. So management are the people who are responsible for designing implementation of the internal control, but the management themselves might override that controls to achieve that fraudulent financial reporting. So how they can override that controls? Like by way of recording fictitious journal entries. They will record the fake entries. Or they will inappropriately adjust the assumptions, like they can play with the accounting estimates. Just now we have covered in the SA 540 accounting estimates. And either they will omit the recognition, or they will advance the recognition. That means next year expenses also they will book here, or they will delay the recognition. Current year expenses they will carry forward to the next year. Or not just conveying wrong information, even hiding the important information is also fraudulent financial reporting. Like company is going through one pending legal case, but the management did not disclose it anywhere. Fraudulent financial reporting. And engaging in the complex transactions, the management will intentionally engage in the complex transactions so that no one will understand, which will provide them an opportunity for committing fraudulent financial reporting. Or even altering the terms and records relating to significant unusual transactions. So this is how different ways in which fraudulent financial reporting can be committed. So till now we did not speak about auditors' responsibilities. This standard is decided, the standard has been given to help the auditor to talk about what are the auditor's responsibilities relating to the fraud. But if you would have paid close attention, we did not talk about auditor's responsibility till now. We only spoke about what is the meaning of the fraud, different types of fraud, how the frauds will happen, what is required for making the fraud happen. Sir, but where is auditor's responsibilities? Now we are coming to the auditor's responsibilities. Okay, sir, we spoke about all the technicalities relating to the fraud, but what about auditor's responsibilities? When it comes to the fraud, what are auditor's responsibility? The standard says 3 responsibilities. Number 1, first you need to identify and assess risk of material misstatement due to fraud. What is the first thing we need to do? We need to identify, is there any risk of material misstatement relating to fraud? So they are not asking you to directly go and find out the fraud. First, they are asking you to find out, is there any chance, is there any risk of material misstatement relating to the fraud? First, you have to find it out. So once you have found out the risk of material misstatement, now you have to respond to that risk of material misstatement. So basically what they are trying to say here is, first we perform risk assessment procedures and try to find out a risk of material misstatement due to fraud. Now, once you have identified the risk of material misstatement, you have to plan your further audit procedures to address that risk of material misstatement by obtaining evidence. That is the second point. To obtain sufficient and appropriate audit evidence about the assessed risk of material misstatement of fraud through designing and implementing appropriate responses. That means by implementing and designing proper further audit procedures, obtain sufficient and appropriate audit evidence. Finally, if you find out any fraud, if you suspect any fraud, or if you find out any fraud, you have to respond appropriately. So these are the 3 matters, 3 responsibilities of the auditor as per SA 240. So what are the 3 responsibilities? Number 1, identify and assess the risk of material misstatement. Number 2, respond to that risk of material misstatement by performing some procedures. Number 3, respond appropriately, report on your identified or suspected frauds. Okay, so let us come to the first objective. They are asking me to identify risk of material misstatement. Sir, but how can I identify that risk of material misstatement? How can I identify that risk of material misstatement? So first objective, how can I fulfill? So here they are saying risk assessment procedures to obtain information relevant to identifying risk of material misstatement related to fraud. So how can I identify the risk of material misstatement relating to fraud? Very simple. At the beginning, when you are performing risk assessment procedures, at that point of time only you should identify, is there any risk of material misstatement relating to fraud? Sir, how can I do that? Simply go and inquire with the management and others within the entity. So go and inquire with the management. Sir, is there any fraud? Is there any chance of happening the fraud? First, you have to go and inquire. Then obtaining an understanding as to how those charged with garnets exercise oversight of management process for identifying and responding to the risk of fraud. So even you have to go and understand, are those charged with garnets having control over management? Are they monitoring the management regarding the fraud related activities? That you have to understand. And also, I need to understand what internal control management has established to mitigate this risk. And even I should find out, are there any unexpected relationships by performing analytical procedures? So basically, you need to perform analytical procedures to identify whether any unexpected relationships are there, which will give you an indication of fraud. So basically, 4 steps you need to perform. So first objective, you need to identify risk of material misstatement, and you can identify that risk of material misstatement by doing 4 steps. What are the 4 steps? Number 1, inquire the management and others. Number 2, understand whether those charged with garnets is having a oversight over the management's responses. Number 3, evaluate what internal controls management is having. Number 4, perform analytical procedures and find out unexpected relationship. Now, after you have performed that audit procedures, you will identify the risk of material misstatement. To that identified risk of material misstatement, you have to respond. And also, this risk of material misstatement can exist at 2 levels, which we will discuss in the risk assessment and internal control chapter. The risk of material misstatement can exist at 2 levels. There could be a risk of material misstatement at the financial statement level. There could be a risk of material misstatement at the assertion level. So what do you mean by risk of material misstatement at the financial statement level? That risk which is having a potential to cause a misstatement in the entire financial statements. Whereas that risk which is having a potential to cause misstatement in only 1 or 2 specific items, that we call it as assertion level. But whatever it is, this we will try to have elaborated discussion in the risk assessment and internal control chapter. But for the time being now, I want you all to realize that there will be 2 levels of risk of material misstatement. One is financial statement level, other one is assertion level. To both the risk you have to respond. So let us see how we can respond to the risk of material misstatement at the financial statement level. If there is a risk of material misstatement at the financial statement level due to fraud, How you have to respond to it? Very simple. If there is a chance of happening misstatement in the entire financial statements because of fraud, what you are supposed to do is, when you are selecting your engagement team, assign and supervise personnel taking account of their knowledge, skill and ability. That means in order to tackle the risk of financial statements at financial statement level, you need to have experienced staff, skillful staff you have to use for this audit. Number two, evaluate whether selection and application of accounting policies are evaluate whether selection and application of accounting policies, particularly those related to subject to measurements and complex transactions. So basically, you need to spend more amount of time on studying the accounting policies, especially accounting policies relating to accounting estimates. There you have to pay more attention. Then after that, incorporate an element of unpredictability. Basically, surprise checks you have to perform. So if you find risk of material misstatement at the overall financial statement level, how you can tackle is, you can respond to that by assigning experienced and skillful staff, and by studying the accounting policies relating to accounting estimates, and finally doing the surprise checks. And whatever risk of material misstatement that you have found it at the assertion level, how you have to respond to it? How you have to respond to that is by performing and designing further audit procedures. So you have to properly design and perform further audit procedures like inquiry, inspection, all that procedures you have to perform to address the risk of material misstatement at the assertion level. And whatever procedures you have designed at the beginning, those procedures you might change it also. So during the course of audit, if you felt that some more extra procedures you have to perform, you can change the nature, timing and extent of audit procedures during the course of the audit. Next, and this is very important. See, they say one general point that in every organization, there is always a risk that management can override the controls. In every organization, this risk will be there. Whether you agree it or not, this risk will always be there in the management, in every organization. Why? Because management are the people who are responsible for designing, implementation, maintenance of internal control. So in every organization, since the management are the top level people, they always have the chance, they always have the possibility of overriding of controls for their own benefits. So this risk will exist irrespective of whether you do the assessment or not. This risk will always be there in the organization. So that's why what SA 240 says is, irrespective of auditor's risk of material misstatement, whether you do the risk assessment or not, compulsorily you should perform the following procedures. Whether you do the risk assessment, see, read this terminology here. So they say irrespective of auditor's assessment of risk of management override of controls. So whether you analyze this risk or not, is there a risk of management overriding controls? Whether you do that assessment or not, doesn't matter. You should compulsorily perform some procedures. Which procedures? Like you need to test the appropriateness of journal entries, whatever journal entries that are recorded in the books of accounts, whether they are appropriate or not. Review the accounting estimates. And also evaluate the business rationale for outside the normal transactions. That means if you find any unusual transactions, you have to understand what is the business logic for it. So whether you make an assessment of risk of management overriding controls or not, these three steps are very, very important. Compulsorily you have to do it. What are they? Analyze the journal entries, review the accounting estimates, and understand the business rationale or logic for transactions outside the normal course of business. And then finally, you get the audit evidence. Whatever evidence you have got, that evidence you have to evaluate. So if by performing that audit procedures, if you find a misstatement that is indicative of fraud, by performing the above procedures, whatever we have discussed, if you came to know that there is a fraud, there is a misstatement which is indicative of fraud, then what you should do is, if you find that there is a misstatement indicative of the fraud, you have to consider its impact on other aspects of the audit. So you should not just satisfy by obtaining evidence from that fraud. You need to evaluate if the fraud has happened in this area, what could be its impact in other areas. Why? Because fraud might not be an isolated occurrence. It could have taken place in multiple areas. So if you find any misstatement indicative of fraud, you need to evaluate what is the impact on other aspects of the audit. Similarly, if you came to know that there is a misstatement in which management is involved, if you came to know that if the management is involved, whether that fraud is material or not doesn't matter. If you came to know even in a small misstatement also management is involved, what you should do is you should re-evaluate your risk of material misstatement. Earlier you thought management are honest people, you thought the risk is low, but now you got to know management is involved in the fraud. You need to reassess your risk of material misstatement, make changes to your nature, timing and extent of audit procedures, and also identify is there any possible collusion along with the management whether other people have also colluded, determine it, and even consider the implications on the opinion, even consider modifying the opinion when especially you came to know management is involved. And even you should perform analytical procedures. This is common. You should study the relationship between financial and non-financial items, and from that you have to evaluate whether any fraud is existing. And sometimes what will happen is, because of some circumstances, because of fraud, you might come across some circumstances because of which you are unable to continue the audit. So circumstances that bring into question the ability of the auditor to continue performing the engagement. So because of the fraud or suspected fraud, sometimes you come into helpless situations where you are in a doubt whether I should continue the engagement or withdraw from the engagement. In that case, what you should do? So in that case, what you should do is, first you determine is there any professional or legal responsibility to communicate with the people who have made the appointment. Whoever has appointed you, go to that person and communicate with them. Or in some cases, there might be a requirement to communicate with the regulatory authorities also. So determine, is there any requirement on you to go and communicate with the people who have made the appointment, or is there any requirement to go and communicate with the regulatory authorities to resolve this issue. Even after that also, if the issue is not resolved, then you determine whether it is appropriate and permissible to withdraw. If you wanted to withdraw, determine is it appropriate and is it permissible. If you have decided that okay, withdrawal is the correct option and it is also permissible, then what you should do is you can withdraw. No one will stop you. But when you are withdrawing, follow the formalities like communicate with management and those charged with governance, and also determine is there any professional or legal responsibility to communicate your reasons for withdrawal to the persons who made the appointment or to the regulatory authorities. So fulfill all your professional responsibilities and withdraw. No one is going to stop you. Next. And apart from that, you need to also obtain written representation from the management and those charged with governance regarding which matters are that they accept their responsibility for internal control. They have disclosed to the auditor results of their risk assessment procedures, and also they have disclosed to the auditor if they got to know about any fraud or suspected any fraud, and they have disclosed to the auditor regarding any allegations of fraud. Basically, whatever information management got to know about the fraud, everything they have communicated to the auditor. Ask the management to give a written confirmation. And finally, if you find any fraud or suspected fraud, you need to fulfill your communication requirements. First, if you got to know about any fraud, you have to communicate to the management or those charged with governance. So if the auditor has identified or suspected a fraud, he shall go and communicate these matters to the appropriate level of management. And also he should also communicate these matters to those charged with governance. And particularly if you came to know that fraud is involving the management, you have to go and communicate with those charged with governance for sure. If you came to know management themselves are involved in the fraud, you have to go and communicate with those charged with governance, and also communicate any other matters related to the fraud. Not just communicate the fraud, provide extra information also which will help them to understand the fraud in a better manner. And in some cases, communicating with the management and regulatory authorities and communicating in the auditor's report alone will not be enough. You might be required to fulfill the requirements of communicating with the regulatory or enforcement authorities like MCA, RBI and all. So determine as per the terms of the contract, is there any responsibility on you to communicate the matter to regulatory or enforcement authorities? If yes, fulfill that requirements also. Sir, will it not breach confidentiality? As we are aware, yes, auditor should maintain confidentiality, but whenever there is a requirement of law or regulation that will prevail, their confidentiality you should not argue. If there is any requirement of law or regulation, there you have to fulfill your communication requirements. And then finally, you have to maintain the documentation. In that documentation, what and all is required to be included, that list has been given here. Okay. And we have one more thing here, fraud risk factors I have given here. So this is something which is just a list of points of fraud risk factors. This thing you can go through, this page you can go through it. What are the fraud risk factors for fraudulent financial reporting? What are the fraud risk factors for misappropriation of assets? Clear? Comfortable everyone? Right, perfect. So we have completed essay 240. Now we will try to quickly do essay 250. Right. So what does essay 250 talk about? Essay 250 is going to talk about auditors' responsibilities regarding laws and regulations while conducting the audit of the financial statements. Which means that, say for example, you are conducting an audit of a client X Limited. See, as we all are aware, any client, they will have numerous laws and regulations to follow. Take for example, this is a company, they might be required to comply with the Companies Act 2013. They might be, if it is a manufacturing company, they need to comply with the pollution related laws and regulations, environmental related laws and regulations. If it is a IT company, data security related laws and regulations. If it is a manufacturing entity, Factories Act and Income Tax Act, GST Act. So like that, your clients might be required to follow so many laws and regulations for their continuation, for their existence. Now, as an auditor, if you are conducting audit of some company, of any entity, what is your responsibility with regard to these laws and regulations? Whatever laws and regulations which management of your client is required to comply, regarding that laws and regulations, as an auditor, what will be your responsibilities? What will be your responsibilities regarding the laws and regulations which are applicable to your client? That guidance has been given under SA 250. But let me ask you one question here. Who do you think is primarily responsible for ensuring the compliance with the laws and regulations? To make sure that these laws and regulations are complied with, it is whose responsibility? Management, not auditor. It is the primary responsibility of the management to ensure the compliance and prevent the non-compliance. So prevention of non-compliances is the responsibility of the management. And it is whose responsibility to detect the non-compliance? It is whose responsibility to detect the non-compliance? So once again, the responsibility for detecting the non-compliances is also rested with the management only. So management and those charged with governance, they have the primary responsibility to ensure compliance, and also they have the responsibility to prevent the non-compliances and also detect the non-compliances. Now, generally what managements will do is they will follow different. It is their responsibility to implement some policies and procedures in their organization to make sure that they are complying with the laws and regulations. As I have told, management is primarily responsible for ensuring compliance with the laws and regulations or not. So to make sure that as a management, their organization is complying with laws and regulations, they implement various policies and procedures in the organization. Sir, what are the examples of such policies and procedures which a management will generally implement to ensure the compliance of the laws and regulations? The list has been given here, important from the examination perspective. So what policies generally management will keep is they will monitor their legal requirements on a continuous basis, and according to their legal requirements, they plan their audit procedure, they plan their operating procedures. Then they will implement proper system of internal control, and also they will develop a document called code of control and they will distribute it to everybody. And also they ensure that their employees are trained. You have to train your employees to make sure that they are complying with the laws and regulations. And also they have to monitor and act appropriately to discipline employees who fail to comply. If at all you find any employee who is violating laws and regulations, you have to take disciplinary action. And they also engage legal advisors. That's why they have legal consultants for big companies. And also they should maintain one register of significant laws and regulations. They need to maintain one complete register of what laws and regulations are applicable for them. And in larger entities, these may be supplemented by assigning appropriate responsibilities to internal audit function. If it is a big organization, even the responsibility of checking the compliance with laws and regulations can be handed over to the internal audit team. So whatever it is a responsibility of management and those charged with governance to ensure the compliance with the laws and regulations by following these policies and procedures. But as we all are aware, standards does not talk about management responsibilities. Standards will talk about auditor's responsibility. Now, what is auditor's responsibility? First question, let me ask you. Can you expect the auditor to prevent a non-compliance? Can you expect the auditor to prevent the non-compliance with the laws and regulations? No. Can you expect the auditor to detect all non-compliances? Definitely not. Why? Because auditor is not appointed to ensure compliance, or auditor is not appointed to detect the non-compliances. The primary responsibility of the auditor is to obtain reasonable assurance whether financial statements are free from material misstatements. He can't be expected to prevent non-compliances. He can't be expected to detect all non-compliances. Does that mean auditor will not have any responsibility regarding laws and regulations of the client? Sir, you are telling auditor is not responsible for preventing non-compliance, and also we can't expect the auditor to detect all non-compliances. Does that mean will auditor not have any responsibility regarding laws and regulations of the client? No, you are mistaken here. So what will be auditor's responsibility regarding the laws and regulations? That's what this standard will explain. So we can't say that audit is completely spared of any responsibility regarding laws and regulations, but what exactly are that laws and regulations, that this standard will explain. And for the purpose of auditor's responsibilities, this is standard SA 250 divided the laws and regulations into two categories. For the purpose of auditor's responsibilities, this standard SA 250 has divided the laws and regulations into two categories. I will call them as category 1 laws and regulations and category 2 laws and regulations. Category 1 laws and regulations are those laws and regulations which are having a direct effect in the financial statements. Or if I put it in very simple terms, if I have to put the technical terms, the standard says those laws and regulations which have a direct effect on determination of amounts and disclosures in the financial statements, that will fall under category 1. Like for example, Income Tax Act, GST Act, PF Act, Bonus Act. So these are the laws and regulations which are having a direct effect on determination of amounts and disclosures in the financial statements. They will have a direct impact on the financial statements. So those laws and regulations will fall under category 1. Whereas category 2 laws and regulations are other laws and regulations. Those laws and regulations which don't have a direct effect on determination of financial statements, but still compliance with them is required to avoid the major penalties, or they are fundamental to continue the business. Like for example, if you take Child Labor Act. See, Child Labor Act doesn't have any direct impact on the financial statements. Does that mean companies can stop complying with the Child Labor Act? No. Why? Because if they don't comply with the Child Labor Act, what will happen? Either they have to pay penalties or they might be required to close the business. So those laws and regulations will fall under category 2. So for the purpose of auditor's responsibilities, SA 250 has divided laws and regulations into 2 categories. Those laws and regulations which have a direct effect on determination of amounts and disclosures, and other laws and regulations. Now what the standard says is, with respect to category 1 laws and regulations, the auditor shall obtain sufficient and appropriate audit evidence. When it comes to category 1 laws and regulations like Income Tax Act, GST Act, PF Act, Bonus Act, when it comes to these laws and regulations, the auditor should treat them like any other financial statement item and perform all the audit procedures and obtain sufficient and appropriate audit evidence. So it is a responsibility of the auditor to obtain sufficient and appropriate audit evidence regarding category 1 laws and regulations. But when it comes to category 2 laws and regulations, if you perform specified audit procedures, it will be enough. Like if you take an example of Child Labor Act, you need not perform in-depth audit procedures. The standard has prescribed certain specified audit procedures. If you perform that specified audit procedures, your responsibility will come to an end. And if you find any non-compliances by performing your procedures, you have to respond appropriately. So 3 objectives of the auditor as per SA 250. When it comes to category 1 laws and regulations, try to perform in-depth audit procedures and obtain sufficient and appropriate audit evidence. When it comes to category 2 laws and regulations, you have to perform specified audit procedures. Depending on that procedures, whatever your findings are there, you have to respond appropriately. Understood? Then now they talk about what audit procedures are required to be performed regarding laws and regulations. Now they give a detailed structure what exactly the auditor is going to perform. So first one, when you are performing risk assessment procedures, here also they have divided audit procedures into 2 categories, risk assessment and further. So when you are performing risk assessment procedures, at the beginning, when you are understanding the entity, environment and its internal control, you should also obtain understanding of legal and regulatory framework. Basically, you should understand legal and regulatory framework. What are the laws and regulations which are applicable for your client? You should understand it. And also you should understand how the entity is complying with that framework, how the management is complying, what steps they are implementing to comply with that framework. That also you need to understand. When performing risk assessment procedures, these 2 things you have to understand: legal and regulatory framework and how the entity is complying with them. Then, sir, you told for category 2 laws and regulations, you have to perform specified audit procedures. No. Sir, what are that specified audit procedures? Here they are saying simple procedures. But these specified audit procedures are restricted only to category 2 laws and regulations. So what are that specified audit procedures for category 2 laws and regulations? Very simple. With regard to category 2 laws and regulations, just you have to go and inquire with the management and those charged with governance, and you have to inspect the correspondence with the relevant licensing or regulatory authority. Basically, any notices have been received from licensing or regulatory authority, that correspondence you have to check, and certain laws require particular attention. Like those laws which have impact on going concern, they might require particular attention. That's all. If you perform these specified audit procedures regarding category 2 laws and regulations, your responsibility is over. Nothing else you are required to do. Just inquire and inspect the correspondence. And you should remain alert to instances of non-compliances. If you find any instances of non-compliances, you have to remain alert to it, and even you should obtain the written representation. You have to even obtain what? Written representations from the management. So this is what the procedures generally you have to perform regarding laws. And particularly if you identify a non-compliance or if you suspect the non-compliance, few more extra procedures you have to perform. See, this is what prima facie we will do. Generally we will do this everywhere. But in case after doing this general procedures, in case if you identify non-compliance or if you suspect the non-compliances, then you need to perform this additional procedures. What are that additional procedures? Number one, you need to understand the nature of the act. Which act has led to this non-compliance, that you have to understand, and you have to evaluate what is the effect of that non-compliance on the financial statements. If you particularly identify non-compliance or if you suspect a non-compliance, you need to understand because of which act this non-compliance has happened, and even you have to evaluate what is the effect of this non-compliance on the financial statements. And also the auditor shall discuss the matter with management, and if the management or those charged with governance do not provide sufficient information, then the auditor might consider the legal advice. If you identify or suspect non-compliance, first you will go and discuss with management and those charged with governance. If they are not giving you all the required information, then what you can do is you can consult a legal advisor. You can go and obtain a legal advice. And if sufficient information about suspected non-compliance cannot be obtained, even after obtaining legal advice also, if you are unable to obtain audit evidence, then the auditor might consider modifying the opinion. And what kind of modification? This is also a case of non-availability of audit evidence, either a qualified or disclaimer of opinion you are supposed to give. Okay, so this is what additional procedures which you need to perform when non-compliance is identified or suspected. Then coming to the next part, reporting. Now comes the reporting. Finally, after performing all the audit procedures, if you have identified the non-compliance, what and all reporting requirements you have to fulfill. Very simple. You have to report the non-compliance to those charged with governance. First thing, you have to go and report that non-compliance to those charged with governance. So if the auditor believes that there is a non-compliance, you have to go and communicate with those charged with governance. Sir, what if those charged with governance themselves are involved in the non-compliance? If low-level people have committed non-compliance, I will go and communicate with those charged with governance. Sir, but what if those charged with governance themselves are involved in the non-compliance? Then the standard says, determine whether any next higher level of authority exists. Is there any next higher level of authority in the organization about those charged with governance? If there exist, go and communicate with that next higher level of authority. Generally, there will not be. So that's why they say the next point, where no such higher authority exists or auditor is confused whom to report, in those cases try to obtain the legal advice. So if low level people are involved or management is involved, go and communicate with those charged with governance. If those charged with governance themselves are involved, determine whether any next higher level of authority exists. If any higher level of authority exists, yes, go and report. If no such higher level of authority exists, you have to go and communicate obtain the legal advice. Next, and not just that, even you need to report the non-compliance in the auditor's report. That means even you need to consider the modification of opinion. So if you have concluded, that means you have sufficient and appropriate audit evidence that there is a non-compliance and it has not been adequately reflected in the financial statements. So you obtained audit evidence that there is a non-compliance and this non-compliance has not adequately been disclosed in the financial statements, then you have to give either qualified or adverse. Which means that if there is a non-compliance, but if it has been adequately disclosed in the financial statements, no need to give modified opinion. You can give unmodified. Only when there is a non-compliance and it has not been adequately reflected, then you give either qualified or adverse. On the other hand, in some cases, I might not be in a position, if I am unable to obtain sufficient and appropriate audit evidence, whether there is a non-compliance or there is no non-compliance, in those cases, since it is a case of non-availability of audit evidence, I will give either qualified or disclaimer, depending on materiality and pervasiveness. And then finally, reporting non-compliance to regulatory and enforcement authorities. In some cases, just communicating with the management or those charged with governance or communicating the non-compliance in the auditor's report alone will not be enough. Even you might be required to report that non-compliance to the regulatory authorities also. It depends on engagement to engagement basis. If there is any such a requirement, you have to fulfill that reporting requirements even with regulatory and enforcement authorities also. Clear? And they say whatever procedures you have performed, whatever evidences you have gathered regarding that laws and regulations, all that should be forming part of your audit documentation. Clear, everybody? Right. Okay. Right. So I think I have to end it with the 200 series today, because it's already been 1:30. Yeah, so we'll end it with the 200 series. In the tomorrow session, we will do audit strategy, planning and program, and quality control. That we'll do it in the tomorrow session. So we have 2 more standards to be covered. That 2 more standards will cover and wind up the session for today. 2 are simple standards only. No need to worry at all. One is a joint audit, just like that we can complete it. And the other one is also 260. These days we are seeing the questions from 260 not as a direct question, but it will be linked actually. 260 is linked at multiple places, so that's why 260 I'm explaining it here. So 260 talks about communication with those charged with governance. So what are the matters? Right. So 260, SA 260 talks about the various matters which are required to be discussed with those charged with governance. See, during the course of the audit, there are various matters which are required to be communicated with those charged with governance. Now, this standard is such a consolidated place where they will tell you all those matters at different instances or what are all those which are required to be communicated with those charged with governance. Okay, so let us try to have a quick look at it. Right. Fine. See, before we can understand what are the matters which are required to be communicated with those charged with governance, since we are coming this across this term, those charged with governance at various places, it becomes necessary for us to know who are those charged with governance. So they have given the definition of the term. Who are those charged with governance? Basically, those people who are having the responsibility for overseeing strategic direction. Those people who provide the strategic direction in the sense where the company's funds should be invested, whether the company's profits should be distributed or not, where they have to expand, which new business they have to enter, which new location they have to open. So these are kind of strategic decision. Those people who are overseeing, those people who are looking after this strategic direction, or those people who have the obligations relating to accountability. That means if something goes wrong, someone should come forward and take the responsibility on their shoulder, no? So those people who have the obligation relating to accountability, like for example, if some company does wrong, their owners will be taken to the custody, right? So those people who have the accountability, who are dealing with the obligations relating to accountability, and those people who are responsible for overseeing the strategic direction, who provide the strategy to the company, and those who are facing the responsibilities relating to accountability, those people we call them as those charged with governance. See, basically, who will come here is top level managements will come here. In companies, it is very difficult. In companies, it is very difficult to identify those charged with governance, because in the case of a company, both those charged with governance and management, both the roles will be played by board of directors only. In many companies, there is a very confusion here. Why? Because in companies, board of directors only will take up the execution responsibility, and they are only the ultimate owners of the company also, because they only provide the strategic direction also. So that's why, especially in the corporate form of structure, in many entities, both the roles of those charged with governance and management, both the roles will be played by board of directors only, right? So whatever it is, these are the people who are falling under those charged with governance. Now, what are the objectives of the auditor? As per SA 260, they say that as per SA 260, as an auditor, you are required to fulfill some objectives. What are they? Number one, you have to communicate with management your responsibilities. You have to communicate with not management, you have to communicate with those charged with governance. What are your responsibilities as an auditor? And also you have to communicate with them overview of planned scope and timing of the audit. So two things you are required to communicate mainly. First objective, go to the management, go to those charged with governance, communicate with them. What are your responsibilities as an auditor? What are your responsibilities? You have to communicate with them. Second one, you have to go to those charged with governance and communicate with them a overview. Give them overview of planned scope and timing of the audit. What is your overall plan? What is your overall scope? So give them a overview of planned scope and timing of the audit. Number two, not just you communicating. If required, you need to obtain relevant information from those charged with governance. It should be a two-way communication, not just you are communicating. If you require any information from those charged with governance, it is your responsibility to get that relevant information. And not just that, you have to provide them with timely observations during the course of the audit. If you have any significant findings, if you have any significant observations, in a timely manner, even those observations are required to be communicated with those charged with governance. And finally, by doing all this, you should promote a effective two-way communication. Why? Because without effective communication with those charged with governance, our audit will be troublesome. Our audit will be very troubling. Why? Because we need cooperation. If we have to do the audit in a seamless manner, in a smooth manner, if you expect your audit to run smoothly, you need cooperation. So that's why promoting a promoting an effective two-way communication will help the audit smooth. So four objectives of the auditor as per 260. Number one, communicate with them. responsibilities of the auditor and also overview of planned scope and timing of the audit. Number 2, obtain relevant information from them. Number 3, communicate with them with the timely observations and promote a two-way communication. Now they elaborate in a detailed manner. Sir, you are telling I have to communicate my responsibilities. What exactly I have to communicate? That they say here. So what exactly I need to communicate regarding my responsibilities is, so you have to communicate that as an auditor you are responsible for forming and expressing an opinion. You have to tell them that as an auditor your main responsibility is to form and express an opinion. And you should also say one more thing, that audit does not relieve the management or those charged with governance of their responsibilities. So tell them that, sir, my responsibility is to form and express an opinion, but because of audit your responsibility will not get reduced. As a management and those charged with governance, you are responsible for preparing financial statements, you are responsible for implementing internal controls. Just because I am conducting an audit, there will be no reduction of your responsibilities. You will not be relieved of your responsibilities. You have to let them know it. So this is what specifically you need to communicate regarding your responsibilities. Then you need to communicate about overview of planned scope and timing. No, sir, what exactly I need to communicate regarding planned scope and timing of the audit? So you have to communicate with those charged with governance an overview of planned scope, timing of audit, including communication of significant risk. And you have to be very careful here. You should not discuss a detailed audit plan and scope. Why? Because that will make your audit ineffective. Only overview you have to share. That's why they use the phrase overview of planned scope and timing of the audit. Next. This now coming to the third point, they are telling that you need to communicate with them all your timely observations. No, so timely observation means these matters, whatever significant findings from the audit are there, all that findings you are required to communicate. Like what are the qualitative aspects? If you want to communicate regarding qualitative aspects, not on numbers, some accounting policies and all, you want to speak about them, you can go and communicate with them. Inappropriateness of accounting policies. If you find that any of the accounting policies inappropriate, it might be acceptable as per applicable financial reporting framework, but if you feel it as not acceptable, that is not appropriate, you can go and communicate with those charged with governance. Or if you face any difficulties during the course of audit, communicate with them. Unless all of those charged with governance are involved in the management, that means if management and those charged with governance, both the roles are played by two different people, then whatever matters you have communicated with management, communicate once again with those charged with governance, and whatever written representations you have requested from the management, request all that written representations from those charged with governance also. And what are the circumstances that affect the form and content of your auditor's report? Like if you want to give a modified opinion, go and communicate with those charged with governance. If you want to include a key audit matter, communicate with those charged with governance. If you want to include an emphasis of matter, communicate with those charged with governance. If you want to include an other matter paragraph, go and communicate with those charged with governance. As per SA 720, you want to include other information paragraph, go and communicate with those charged with governance. And other significant matters as per professional judgment, not just the above, all other matters as per your professional judgment. And there is one more thing, especially in the case of listed companies, it is mandatory that auditor should communicate with those charged with governance regarding their independence requirements. Mandatory. So as per in the case of listed companies, it is mandatory for the auditor to communicate with those charged with governance regarding the independence matters. So what exactly you will communicate regarding independence is, you have to say that your engagement team, your firm, your network firm, everybody has complied with the ethical requirements. You have to let them know, you have to communicate with them that your engagement team, your firm, your network firm, everybody have complied with independence. You have to communicate with those charged with governance. And also you should communicate with them the relationships that might affect independence, like what are the audit services you are providing, apart from audit what non-audit services you are providing, and what is the fees for audit and non-audit services which would have an impact on your independence. This all we will see in the professional ethics in a detailed manner. So basically independence related requirements you have to communicate, like what audit services you are providing, for which of the entities you are providing non-audit services, what is the fees for audit service, what is the fees for non-audit service, whether the audit service fees is more than non-audit fees or not. So all these council guidelines are there. So you have to communicate all these requirements with those charged with governance in the case of listed entities. Sir, how the communication process should happen? As we all know, generally communication should happen in a written format. But they say that in the listed entities, they have compulsorily told in writing. In other cases, if you feel oral is inadequate, then do the communication in writing. And we all know that communication in oral format will always be inadequate. So it will always be better in all the cases to do a written communication. And whatever matters you have communicated with those charged with governance, everything should be included in your audit documentation. Clear? Next. So now we have one more last standard for today to discuss, which is SA 299. You guys are all well versed with it, which is talking about joint audit. Simple standard. Just hardly 10 minutes it will take for us to revise. We'll revise the SA 299. We'll wind up the session for today. Thank you guys. Being a Sunday, still people are staying on live watching. Your efforts will definitely pay you off. Right. So we'll discuss one more last standard. We'll revise one more last standard for today. After that, we'll wind up for today. So which is talking about joint audit of the financial statements. So first of all, what do you mean by joint audit? When an audit of a single entity is done by more than one auditor, or if I put it in simple terms, when more than one auditor, when I say more than one auditor, more than one audit firm actually. See, if a firm is having multiple partners and if that firm is appointed as an auditor, that we don't call it as joint audit. When I say more than one auditor, more than one audit firm. So when more than one auditor is appointed for the same entity, for the same financial year, and also for the same scope of work, for the same entity, for the same financial year, and also having the same scope of work, if more than one person is getting appointed, that audits we call it as joint audits. So basically, if you look at the audit report of the Reliance, at the end of the audit report, you will find the partners from two different audit firms assigning the audit report. That means the Reliance company, for doing the company audit for the same company for the same financial year, they have appointed two audit firms for conducting the audit. Similarly, if you look at the audit reports of many banks, you will find audit reports being signed by many partners on behalf of many audit firms. That means those entities for the same financial year, for the same scope, for the same entity, they have appointed more than one auditor. So those kind of audits, we call them as joint audits. Now the question is, sir, why people will go for joint audit? Why the companies will go for joint audit? Why the companies will go for joint audit is because they are finding so many advantages in it. Sir, what will be the advantages of having joint audit? Like as you could see, expertise will be shared and there will be mutual consultation. Those joint auditors can have a mutual consultation among themselves, and that will improve the quality of the service. Like as you could see here, better quality of performance, workload will get reduced on each auditor, and overall client will become happy because he will get an improved service. And even it will promote a healthy competition among the auditors, and even quality and speed of the work will get increased. And even you can use the auditors having different experiences at the same time simultaneously for a single entity. But as we all are aware, when one work is done by multiple people, there will always be disadvantages also. So not just advantages, this joint audit is also coming with so many limitations or disadvantages. The main problem is superiority complex. That means people might develop ego complexes. So joint auditors might have a feeling that why I should listen to the other auditor, why I should share my work with him, why I should cooperate with him. That superiority complexes is a major problem which will be a major obstacle to the work. Not just that, this joint audit will not be suitable for small entities. Why? Because it will be very expensive. And lack of coordination. Joint auditors might not coordinate with each other, which will overall reduce the speed of the work. And even because of others' mistake, you have to face the consequences. There will always be a doubt that because of others' mistakes, you might have to face the consequences. And even some common areas will be there which everybody will ignore. And even audit fees has to be shared. Previously, if you are a single auditor, you used to enjoy the total audit fees. Now joint audit the company has opted for, you have to share your audit fees with other joint auditors. Next, okay, now what is the mechanism of the work? Sir, when more than one auditor has been appointed, how the audit will happen? See, for example, Reliance has appointed two auditors, two audit firms. Does that mean each audit firm will do audit separately, and will there be two audits happening for a single entity? The answer is no. When joint auditors are appointed, generally what will happen is those joint auditors will share the work among themselves on suitable basis. They will divide the work among themselves on suitable basis. Sir, on what basis they will divide the audit work, sir? They can divide the work on multiple basis. They can divide it on the basis of assets, liabilities, incomes and expenditure. On the basis of geographical areas, they can divide. On the basis of period of the financial statements, they can divide, or even on the basis of identified units also they can divide it. So whatever may be, whenever they are dividing the work, they need to prepare one document in which they have to clearly explain which person has done which work, which person's responsibility is which work, that they have to clearly document it, and all the joint auditors must sign it. Okay. Now, okay, sir, they are dividing the work among themselves. Then what about the responsibility? What about the responsibility? So SA 299 says that each joint auditor will be held responsible only for the work which was allocated to him. Like say for example, Reliance Industries Limited joint auditors, they have divided the work on the basis of period of the financial statements. First joint auditor first 6 months, second joint auditor next 6 months. Now each joint auditor will be held responsible only for the work which was allocated to him. Say for example, if joint auditor A is taking care of April to September transactions, he will be held responsible only for April to September transaction. And joint auditor B is looking after October to March transaction, this joint auditor will be held responsible only for the misstatements not detected in the month of October or March. So generally, each joint auditor will be held responsible only for the work allocated to them. But however, the standard says that there are certain areas where all the joint auditors will be held collectively responsible. There will be a joint responsibility in some matters. So there are certain matters where every joint auditor will have equal responsibility. What are those matters? Number one, if there is any undivided work, if some work is not divided among any of the joint auditors, if something wrong happens regarding that work, every joint auditor has to face the consequences. Or if some decision has been taken by all the joint auditors, if that decision has been gone wrong, then also everybody has to face the consequences. Or matters which are brought to the notice of all the joint auditors. If there is one matter, say for example, one joint auditor is there, he found one mistake, but he did not keep that mistake to himself. He communicated with all the joint auditors, but none of them have taken the action. Then also everybody will face the consequences. If you don't know the matter, that's why you did not take the action, the law will spare you. But if the matter has been brought to the notice of all joint auditors, but none of them have taken the action, then also all the joint auditors have to face the consequences. And also presentation and disclosure of the financial statements as required by applicable financial reporting framework. This is also the responsibility of all the joint auditors. And also for giving the audit report as per the relevant statute, this is also the responsibility of all the joint auditors. That means if something goes wrong in any of these areas, all the joint auditors will be held collectively responsible. Okay, we have seen responsibilities. Now what about reporting, sir? Sir, if joint auditors are there, will joint auditors give separate audit reports? No. Say for example, 14 joint auditors are there for SBI. Do you think all the 14 joint auditors will give separate 14 audit reports? No. See, generally what will happen is all the joint auditors, once they have completed the audit, they will sit together, discuss all their observations, discuss all their findings. They will arrive at one common opinion, and that one common opinion will be expressed through a single audit report. Generally, all the joint auditors will arrive at one common conclusion, and that one common conclusion will be expressed through a single audit report. But sometimes what will happen is there will be differences of opinion. Say for example, out of this 14 joint auditors, 13 joint auditors are saying unmodified opinion, one joint auditor is saying modified opinion. Sir, if there is a difference of opinion, should the person who is having a difference of opinion, should he go with the majority? The answer is no. SA 299 says if there is a difference of opinion, no need to go with the majority. Then what will happen? Then what will happen is let them give their own audit reports. These 13 joint auditors will give a single audit report containing an unmodified opinion. This one joint auditor will give a separate opinion containing a modified opinion. And now these two reports will be given to the management. Management will circulate both the reports to the shareholders. Now which report shareholder has to rely? That is completely shareholder's choice. But whatever it is, there is no requirement to go with the majority. You can give your separate opinion through a separate audit report. Then, and also a few more things to say here. Few more things to responsibility we have seen. Yeah, dependence on the joint auditor. See, can each joint auditor rely on the other joint auditor's work? Yes, joint auditors are entitled to rely on other joint auditors' work even without verification. You need not doubt the other joint auditor's capability. Why? Because he is also equally capable like you. So as a joint auditor, you can rely on the work of other joint auditor even without any review. Next one. Now this comes the next part. What are the special considerations when joint audit is happening? What are the special considerations you have to keep in mind? So here they say that it requires engagement part while planning the audit. The engagement partner and engagement team from all joint auditors should participate in the planning. all the engagement team and all the members of the engagement team and engagement partner from all joint auditors should participate in the planning of the audit. They should establish one joint strategy. They should not have different strategies. They all should have one joint overall audit strategy. And in developing audit plan, so all the joint auditors should collectively develop the audit plan, and in that audit plan they have to identify the division of areas, which person will do what work, that they have to identify. They have to ascertain the reporting objectives. They have to consider all the factors those are significant in engagement team's efforts. They have to consider results of preliminary engagement activities, and even they need to determine nature, timing and extent of resources. See, these are all common. These are the factors which we do in the normal audit also. So if you look at the audit strategy planning and program chapter, so there you will find what factors are required to be considered while establishing audit strategy. Same factors we will consider even in the joint audit also, but only difference is in a normal audit single auditor will do it. In the joint audit all the joint auditors will collectively consider all of this in their planning decision. And then finally each joint auditor should assess the risk of material misstatement, and they have to and communicate with other joint auditors, and the joint auditor should discuss and document among them nature, timing and extent of audit procedures, what they are going to perform regarding specific and common areas. So watch what every auditor will do, that also they have to document. And then finally they will get one common engagement letter. They will not get different engagement letters. They will get one common engagement letter, and they will get one common written representation from the management. And as I have told, on whatever basis they are allocating the work, that should be put on a paper, and that work allocation document should be signed by all the joint auditors. That's all. So this is what SA 299 is all about. So with this we have completed 200 series of the standards also. So we have completed 500 series, we have completed 200 series of the standards. Clear? So that's all for today guys. This is what day 2 of the CA final marathon. So tomorrow we will have the day 3. We will continue with the remaining chapters. Okay, right. So thanks for your active participation. Take care. See you in the next class.